Tailwind. Plus, Biden vows to end the, quote, darkness. Joe Biden rebukes President Trump in his address at the Democratic Convention, calling his opponent a national embarrassment. He promises to support the working class and reform taxation. Matt?
Let's take a look at what's going on in terms of futures. Just a few seconds to go until the start of live trading. We see FTSE futures turn around a little bit. They were down further this morning. Now they're unchanged. European futures are rising about 1/4 to 0.5% on the continent. Let's take a look at the live trade. This is the global macro movers screen. And in the far left-hand column, you'll see equity indexes as they open up. You can see the FTSE there, little change right now. The OMX opening up in Stockholm up 1/3 of 1%. And we should see other continental indexes open up higher as well when they start live cash trading. It's taking a little while on this Friday morning. There you see the DAX up 0.4 of 1%. The AEX little changed in Amsterdam. The CAC 40 up 1/3 of 1% in Paris. So for the most part, Anna, we do see gains, even if there's little change really in the UK.
Yeah, some of those travel and leisure stocks actually making some gains as well. Interesting timing for that. Now, European equity markets then opening higher. That's after tech shares propelled the Nasdaq to another record in Thursday's session, despite an uptick in U.S. unemployment claims numbers, I should say. We're joined now by Jeffrey Yu, senior strategist for EMEA markets at BNY Mellon. Jeff, thanks very much for joining us. Earlier on, I was talking about some research by one of my colleagues and talking about where we go with tech stocks. I said it was John Authers. It wasn't. It was Barry Rittle. So I just want to correct that. But he was basically saying, don't be too concerned about over-concentration of gains in tech stocks. Does this worry you, the reliance on tech for gains stateside?
It certainly does. You know, there's this notion of it ain't broke, don't fix it, right? So yesterday, I think, was a clear example of this. I think we had the earliest indicators, that the U.S. labor market is facing some stress, with the initial claims numbers, but ultimately it got shrugged off, and the leaders, yet again, with respect to the S&P, information technology and communication services, I guess we can take some part that if you look at consumer staples, yesterday and discretionary, they were sort of flat on the day, so not too much downside for the household yet, but we're just relying on one sector right now. That doesn't reflect the state of the U.S. economy. This disconnect needs to be corrected at some point.
And, we do see the S&P 500, one of the only major indexes outside of China showing gains year to date. Here's a look at the NASDAQ 100 and the overextension. But I wonder, does the tech stock outperformance explain away the big difference between gains in the U.S. benchmark compared to a FTSE that's down 20% year to date?
I think it does to some extent. So composition is very important. So US is considered really the only viable growth market right now. If you want a price in growth, especially high productivity growth, driven by tech, then US is where you want to be. China is a bit unique insofar as the Chinese onshore market is very concentrated with domestic exposure. So it's exposed to the domestic economy. And if you're of the view that China has handled the COVID recovery and will be able to manage things and growth a bit better compared to the rest, then it can outperform as well. But there's a greater dispersion of what's actually driving things in China. And crucially, and here's the big difference, US fiscal, nowhere to be seen right now. China, continued fiscal support. And that's going to make a difference in the coming months and quarters.
Jeff, how are you preparing portfolios for the coming election in November? Because the more I talk to guests about what kind of impact we might see if we were to see a Biden presidency, the more confused that the market's assumptions seem to be in my mind. So what are you assuming at the moment?
So I think there are three factors here. Firstly, will there be any material changes, to the COVID situation? I think it's a fast evolving process, and we have to think about vaccines as well. So that probably is, somewhat, beyond his control, beyond anyone's control. Secondly, from a domestic point of view, in addition to regulation, and this encompasses a lot of sectors, people are going to be looking at taxation as well. Whether policies, will change. We know what happened in 2017, where fiscal stimulus, driven by tax cuts, that was material, for U.S. outperformance. And thirdly, what's going to happen to the trade war? What's going to happen to international relations? And here's where I think the views and the positioning needs to be a bit more nuanced. I don't see, any rapid, U-turn or anything in terms of Sino-U.S. trade relations or the broader theme of deglobalization. So for portfolios, hoping to actually go back to, say, 3 or 4 years ago in an era of pro-globalization, I think they're going to be disappointed. But I think it's going to be a combination of those three factors. In the short term, I think the economy, how the labor market comes through, that's going to be the ultimate factor.
I mean, one of the things that I thought was interesting in Biden's speech yesterday is that he really attacked the president for allegedly mishandling the COVID crisis, and said, he has a plan on day one. He's going to handle it correctly. Do you think the market has faith that, changing the person in the White House, changing the party in the administration will set the COVID crisis on a path to recovery?
I'm not sure the market's actually taking too strong a view on that right now. So especially, if, vaccines actually can, come online over the next few months, then sentiment can turn around very, very quickly. And this is not just about the US, it's actually, everywhere. I believe, and feel free to correct me on this, and the RKI and in Germany mentioned that a few, may actually be a viable come autumn. So I think, there are just so many different dynamics with respect to COVID. And we also know in the US, the state's response is actually just as important as a national level response. So that interaction is going to be important as well. I think ultimately the market, what it will want from the White House is what the fiscal plan. Is there going to be a new fiscal injection, to get the economy back on track, to make sure unemployment turns around, to get back to, where we were pre-COVID? That's going to be much more important.
Jeff, thanks very much. Jeffrey Yu from BNY Mellon. Stay with us a little bit longer on the programme. Coming up, we'll talk to Jeffrey about what's going on in Europe. The ECB wants clearer signs of a recovery before it decides on a direction for more stimulus. Will PMIs due out this morning be the evidence that the ECB needs? We'll discuss next. This is Bloomberg. Welcome back to the European Market Open. Just coming up to 10 minutes into the European equity trading session, and we have got some gains coming through, up by 0.4%. The FTSE 100 fairly flat, but other markets looking more buoyant. US futures point modestly to the upside. The Nasdaq futures up by around 0.1%. Let's take a look at some of your movers, some of the stocks that are on the move this morning, individual stories that have caught our eye. Adyen, the payments company, falling after executives sell shares there. We've got a share price of 1364, so down by around 4% for the Adyen share price. EasyJet climbing after UK travel corridors with Portugal have been reopened. Novartis is gaining after the US FDA approves Kesimpta for the treatment of relapsing forms of multiple sclerosis in adults. That stock is up by 1.2%. Now, the European Central Bank policymakers want clearer signs of an economic recovery in the lead up to their next policy meeting. Minutes from the July session showed uncertainty about the extent to which they'll have to deploy monetary stimulus. Today's PMI numbers, with French data due imminently, could be the evidence they need, perhaps. Jeffrey Yu from BNY Mellon is still with us. Jeffrey, I wonder what value PMI indicators give us right now. This is survey data. It relies on sort of sentiment of purchasing managers, which has, their sentiment has been roiled just like the rest of us through this whole pandemic. What clear signals are we getting from that kind of data, or are you looking elsewhere?
Well, I'm actually looking at, how high things have been for the August numbers, and actually, I'm sorry to say, it gives us an indication of what the potential downside is, because we've seen in Europe, France, Germany in particular, services has actually been driving the positivity as economies and societies actually open up. But now with the onset of a second wave, and we've all read about the rise in cases on the continent over the last few days or so, then things can actually start to contract again or start to decline again. So this is actually going to drive sentiment up ahead. We've had some stellar prints in the services numbers. We know the manufacturing side is probably going, yes, it's recovered, but it's going to be the doldrums for a while because global demand is soft. But now the risk is absolutely to the downside with services, and I think that's what the ECB will be worried about up ahead.
Can the ECB do something that really move the needle as far as markets are concerned? I mean, you mentioned, and I think rightly so, that investors are expecting or are going to make decisions based on what they get fiscally out of the U.S. Isn't that the same here?
Yes, though if you look at the government support plans, say for France, for example, 2 years worth of support, that is almost a given. You do have a larger state sector. You do have expectations that the state will play a greater role on the continent. So the pricing there is more marginal. I think from the ECB's point of view, it's important to note that the minutes that we've seen just now, they were taken before the result of the EU summit in July, so they can get a fiscal boost there over the next 2 years or so. What's more important for the ECB is what happens in the shorter term. And here, probably the Fed will lead the way. If the Fed officially adopts some, let's say, average inflation targeting or outcome-based forward guidance, then that is a widening of policy differentials versus Europe versus the rest of the world. So will Europe feel compelled to actually follow that, or at least keep the gap where it is, especially now that euro is trading at close to 120, rather than closer to 110, because that's a headwind for inflation.
Right, and that's exactly where I wanted to take us next, Jeff, and that is the strength of the euro. How worrying is this level, do you think, for European businesses, for the ECB even? I spoke to one strategist earlier this week who said it wouldn't worry the ECB until it got to 130. What's your line in the sand?
So I think the ECB will have to look at things on a basket basis, so on a nominal effective exchange rate basis and real basis as well. As long as domestic demand, as long as households actually they can recover. So basically, if we see domestic retail sales still pick up, if we see domestically driven prices, if those numbers are firm, then I think they can be comfortable with euro-dollar trading at these levels. Of course, if we get another 10 figures within the next 2 or 3 months, that could be problematic. Currencies pass through, yes, there is an impact, but sometimes it's much more about pace, much less about levels. If we get to 130, say by this time next year, I don't think the ECB will have too much of an issue with that. If we get it in 6 weeks, then they will have a problem with it.
All right, I just wanted to remind viewers that we're getting French PMIs in a number of, well, in about 20 seconds here, we're going to get German PMI numbers out as well. These are, if like me, you feel like PMIs come out every week, it's actually that you get a preliminary reading and then a final reading. And then there's a different PMI figure that comes out, so a third one. So 3 times a month, you get a set of PMI numbers. In any case, we are just about to get the French PMI numbers. The survey was for a manufacturing PMI of 53. That has been widely missed right now. The print is a 49 on manufacturing PMIs. The services PMI, the survey was for 56.3, and that's been missed by a long shot as well at 51.9. The composite is 51.7, well below the survey of 57. So French PMIs miss. And this, you know, Jeff, after we get the jump in jobless claims, how important is each little data point? And especially, I guess PMIs aren't a little data point. People put a lot of faith into these numbers.
Indeed. So you know, there's always this argument: do you look at hard data? Do you look at soft data? In the US, it looks like employment, you know, hard data, that's starting to look a bit worrying. Here it's the soft data, you know, that's worrying. But if soft data is actually going to lead hard data, markets are going to start to say, okay, are we looking at a very, very soft Q3 up ahead? Is it going to generate more volatility up ahead? Because the clear risk is the sharp recovery, the V-shaped recovery in Q2, if you really want to call it that. I think expectations of that were a bit over-optimistic in the first place. You know, then that is really, you know, not going to extend into Q3. But what can we actually do to offset it? You know, what can policymakers do? Yes, you know, we do have the EU recovery plan, you know, but that's a story for the next 2 years. You know, is sentiment, are plans enough? Is anything else actually, you know, going to, you know, add to the problems? And ultimately, it's about household sentiment. It's about the labor market. If household sentiment starts to deteriorate, then governments and central banks, they have a problem.
All right, Jeff, thanks so much for joining us. Really appreciate your time this morning. Jeffrey Yu is a senior strategist for EMEA markets at BNY Mellon. Now, coming up, avoid a new lockdown at any costs, as well as border closures. The German chancellor's warning to Europe as the bloc deals with a new spike in coronavirus cases, as well as battered economies. This is Bloomberg.
Welcome back to the European equity market open, and 20 minutes into a session that's fairly mixed, actually. We started off in positive territory, now retreating a touch, and the FTSE 100 is part of the reason for that, underperforming down 0.25% this morning. Now, Infosys is one of the largest IT outsourcing companies in the world and has seen its business battered not only by a global pandemic, but also changing immigration policies across the West. They're forcing the firm to pivot to more locally hired talent rather than bringing IT consultants from India. Bloomberg's Caroline Hyde spoke with the Infosys CEO, Salil Parekh, about how he manages changing geopolitics as the US election approaches.
What we are seeing really is the large Western markets and countries have put tremendous emphasis on policy responses, fiscal responses, and we see those benefiting essentially the business community, where they're enabling many of these large businesses to continue with their sometimes short-term and medium-term investment thinking. There's definitely been somewhat of a rapid comeback in what we see within the US market. There are different scenarios in different countries, broadly in Europe. However, there's a consistent theme that there's significant policy response there as well. And we see similar things in some of the markets that we serve in Asia Pacific, for example, in Australia or Japan. And so overall, there's been quite a concerted push by governments to support this level of growth or this level of activity. And we think that that's going to support our business and even the technology transformations in the medium term.
Some policy responses, particularly here in the United States, haven't favored your business at the moment in terms of the inner workings of Infosys. For example, I'm thinking first and foremost about immigration, the US visa approvals, the standstill there, but we've also seen some strain put on visa approvals in the UK and Australia as well. Is this a long-term shift, do you think?
So here, one of the things we've put in place a few years ago is a concept we've called localization. For example, in Europe, in the US market, in Australia, we've been recruiting employees from colleges directly, as also from lateral hiring. Last year, for example, in the US, we recruited 1,200 college graduates. Since we've made this shift over the last couple of years, we've recruited over 13,000 employees within our US business locally. So while there's been some changes in the policy approach in this area, since we've put in place our own thinking and executed on localization, we see less impact into our business model as we look ahead. In the US, we've set up 6 new digital centers over the past couple of years. For example, a digital center in Indianapolis, in Raleigh, in Phoenix, in Hartford, in Rhode Island. And these are centers that are helping us to scale our business in the US as well.
That was Infosys CEO Salil Parekh speaking exclusively with Bloomberg's Caroline Hyde. Now, a COVID vaccine being jointly developed by Pfizer and BioNTech is on track to be submitted for regulatory review as early as October. That timeline would make it one of the fastest moving vaccines in the world. For more, Sam Fazeli, the Director of Research for Bloomberg Intelligence, joins us. So, Sam, how promising is this development?
Good morning. Obviously, it's actually not new news. They've had this timeline before. I even heard once September mentioned. So I'm glad they've got rid of that, because that would have been incredible in terms of having data. And I have to wait and see how this pans out. You know, AstraZeneca's been at this for a little bit longer than they have, and they've recruited about the same number of individuals into their trials. So there are a lot of things that can go wrong with clinical trials. So I remain hopeful But we need to just wait and see how it all pans out. If they can file by October, then great.
Sam, good morning. I suppose I'm wondering from an investor perspective, what is the definitive piece of information we're looking for around vaccines that's really going to lift the mood for investors and allow people to see the light at the end of the tunnel? Will it be around a vaccine that works? Will it be around regulatory approval or production capacity? Or will it be a mix of many of those things from many different pharma companies?
I think each of those steps are valuable. So once the phase 3 data, phase 3 trial is completed, in fact, as it's being conducted, no news is good news in terms of there are no side effects that are occurring that are causing a potential need to stop recruitment of patients or injection of inoculating folks. So that's already a good news. And we know that 8,000, 9,000 folks have been subjects have been inoculated with the adenovirus from AstraZeneca. We know 10,000. So far, so good. I mean, it's very, very early days, obviously, because these side effects sometimes with vaccines come out only after everyone's been using the vaccine for a year after approval. But so far, so good. Then you have the announcement that they've completed the phase 3 and they've succeeded. We need these vaccines to do better than the 50% that the FDA requires. And even 50% reduction in severe disease is a good thing to see. So, and of course, then you've got the FDA to look at this. They see a lot more data than we do. And there's always a little risk that they kind of go, we're not quite sure about this, that we haven't seen.
Okay. Sam, thanks so much. Thanks for the update. Sam Fazeli, Bloomberg Intelligence Director of Research. Up next, Bayern Munich takes on PSG for the Champions League title on Sunday. Ahead of the big game, we're looking at the money behind this sport. More on that next. This is Bloomberg. Welcome back to the European Market Open. It's Friday morning, 30 minutes into Friday's trading session. It looks fairly flat, actually. We're entirely flat on the Stoxx 600. The FTSE 100 and the CAC underperform just a little bit. We do see some modest gains coming through on the Xetra DAX. Talking of gains, though, if we look at things from a sector perspective, you can see that travel and leisure is by far the biggest gaining sector. Some of that is coming from the aviation sector, where we see the likes of Ryanair moving higher, up by 1.1%. I think EasyJet also higher, yet by 1.2%. So we do have a little bit of upside for some of the aviation businesses, but it's more than that. It's also gaming businesses, catering and hotels too. So some reasons for optimism, it would seem, in investors' minds. Let's get a Bloomberg First Word News update. Here are some of the top stories we're covering this morning here at Bloomberg. The US has handed the United Nations its demand to reinstate global sanctions against Iran. Secretary of State Michael Pompeo is hitting out at European allies who oppose the move, accusing them of a failure to lead and of appeasing Tehran. Iran has pushed back, saying the United States is attempting to mislead the world. Former Vice President Joe Biden has officially accepted the Democratic nomination to challenge President Donald Trump. He used his keynote speech at the virtual event to urge Americans to overcome deep political divisions. He says Trump has, quote, cloaked America in darkness for too long, and that he'll be an ally of the light, not the dark. Hopes for a Brexit deal are fading. Little progress is being made on key obstacles to an agreement. Bloomberg sources tell us the British negotiators sought to break the deadlock. They submitted a draft free trade agreement based on what they saw as common ground with the EU. But so far, that hasn't led to a breakthrough. The latest round of talks wraps up today. Opposition activists in Russia say doctors are refusing to release anti-Putin campaigner Alexei Navalny for treatment abroad. The doctors say his condition is too unstable to travel. State news agency TASS reports that he is still in a coma. A plane has already arrived to transport Navalny to Germany for medical treatment. His team blame President Vladimir Putin for his illness, saying he was poisoned. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Matt.
All right, so sport is going to be a big deal this weekend. Not only is there another MotoGP race in Austria, but there's a really big football match, soccer game, if you will. Bayern Munich is going to play Paris Saint-Germain in, I guess it's the Champions League final, European finals. They may be taking place behind closed doors, but the allure of the game and the silverware up for grabs should still excite fans around the globe, but especially here in Germany, because Bayern Munich is one of the teams playing, and Germans think they're the best team ever. Joining us to discuss this is Bloomberg News' David Hellier. David, what can we expect from this final on Sunday night? I'm not overselling it, am I?
No, not at all. I mean, these are, two of the world's biggest teams, and PSG, for them, it's a big dream of the Qataris who bought the club 9 years ago. To win the Champions League is the pinnacle of one's ambitions in European football. Bayern Munich, used to being in the Champions League final or at the later stages, very, very powerful in Germany. Normally wins the local Bundesliga, as it did this year. But it's a very big game, and a lot of people in England have commented on how English teams, after last year being in the final, there's an all-English final, of course, between Liverpool and Tottenham. There's no English teams there, despite the fact that 8 English Premier League clubs are in the top 20 of world football in terms of revenues.
David, good morning. How will we see the game continue to change? Clearly, the COVID situation meant that we saw no football for a very long time, and then it's come back, and it seems to be on every moment of the day, but it's under very different circumstances, of course, without crowds being the most obvious difference. How do we expect things to change?
I was heartened yesterday by the Scottish minister saying that in September the 14th there's going to be some fans allowed back into Scottish matches, because really football without fans is in a difficult place. I think so far it's done incredibly well The leagues that restarted in Germany, Italy, Spain and England have done incredibly well to finish the league without too many hiccups and without fans. But to keep interest going, personally, I think you need the fans. It's a different experience. It's not as a rich an experience. For the moment, though, you know, we're just pleased as football fans, we're just pleased to see these big games coming along.
You know, the Union Club here, the sort of former East Berlin team, has a really cool idea that they're going to be testing fans that want to go to the game, and as soon as you get positive or a negative result, that is, you get your digital tickets authorized and you can go. They're going to do a trial run, and they need the fans, right? Because this is what brings a lot of the revenue. How much cost has the COVID pandemic? How much money has the COVID pandemic cost football?
Well, I mean, it's cost. If you take just England for one league, Deloitte says it's cost £1 billion amongst the 20 clubs. It's not just the spectators that aren't there; it's the renegotiation of broadcast contracts, because the broadcasters they're saying we're not getting the same product that we had. I mean, a lot of the allure of football is the passion and excitement of the fans in the stadium. And whilst showing these games is better than nothing, it's not the real thing. However, if you look at some of the big clubs like Manchester United, Bayern Munich, Liverpool, they're not so dependent on spectators. So, Man United, only 17% of its revenue comes from the spectators, even lower at Bayern Munich, 14%. So they don't need them in the short term as much financially, but they do need them in the longer term, because you know, if you stop going to football, you kind of get out of the habit of you know, mixing with people, being excited by it. And I think you know, there's so many different counter attractions around, you know, especially with esports. I think football needs the fans back in the stadium as soon as they can. But obviously, there's the, you know, health considerations are very considerable.
Mm. Yeah, surely some things are worth getting out of the house. Well, David, thank you very much. Bloomberg's David Hellier with the latest on football and how it's changing amidst the pandemic. Let's get back to the economic data. We've got some numbers coming through from Germany just in the last few minutes. So German August manufacturing PMI 53, the forecast was 52.3. So unlike France, we see that is above 50, the German number, and it is also better than the estimate, but only by a bit. The services number, though, does have something in common with the French story. The services number also above 50, but it is substantially lower than the estimate, and that we saw in France as well. So services PMI falling to 50.8. The forecast was 55. So we've seen a sizable move in the euro as a result. 118.38 is where we trade, so we're down around 0.2% overnight on the euro, and some of that came through as we got the French number at the top around 15 minutes ago, but so adding perhaps, or at least sustaining those losses with that German number. Up next, could owning clothes be a thing of the past? We'll be hearing from Victoria Prue, the CEO of the fashion rental startup Her Collective. What is it like running a sharing business, a sharing economy business right now? We'll talk to her about that. This is Bloomberg. Welcome back to the European market open. Slightly volatile start to trading this morning. We're back in positive territory, up by 0.3%. The FTSE 100 underperforms, down 1/10. Now, the pandemic dealt a major blow to both the sharing economy and retail, but Selfridges is betting on salvation in the fashion rental market. This week, the luxury department store launched a partnership with Her Collective, joining the ranks of Rent the Runway in the United States. The startup targets millennial shoppers looking to save on one-off luxury items. We're joined now by Victoria Prue, who's the CEO of Her Collective. Victoria, very good to speak to you this morning. So just how big do you think this sector can become versus retail of clothing? How big will rental be?
So our hope is that rental is the future of fashion, and I see rental as playing a big part in the women's everyday wardrobe or in the fashion industry more generally. So I think we'll see over the next kind of 2 to 5 years, rental really taking a mainstream and being much more of a kind of everyday occurrence and something that's just considered to be for high days and holidays.
If, when I think of renting high-end clothing, I think of going to a gala. I mean, for me, it's easy, right? I just buy one tuxedo and I'm set for the rest of my life. But for my wife, going to a gala, going to a ball, something where you might have to spend more than 100 or even 1,000 pounds on a dress. How many of those things are happening these days, Victoria?
You're completely right. Obviously, the event side of our business was largely impacted by COVID, but I think rentals moved quite significantly, shifting from a kind of wear it once, the ascot or a 50th birthday, say, and a 2 or 3 event a year model to something that's incorporated much more every day. The majority of our users, they rent for staycations, they rent for dinner parties, for picnics in the park. These are a kind of mini events, as we call them, that people are renting for that are happening, once or twice a week, and just changing up their everyday wardrobes to be more elevated. So for us, rental has shifted from something that's just that gown that's, a sequin beaded maxi dress into a funner top that's, £40 or £20 to rent for 4 days, that people are doing much more frequently now.
And Victoria, what kind of changes have you had to make to the business around the pandemic? Because when I think of models around the sharing economy, I used to do car sharing a lot more before the pandemic than I do now, for example. Is this something that challenges any model that requires sharing items?
Of course, we've always been really, really clear about our policies on hygiene, cleanliness, and how it works through the platform. We also introduced contactless deliveries throughout lockdown to make sure that our users were really happy. And we've also been really, really clear on what's required from the users. So we use, in terms of the stock, particularly in the Selfridges stock that we'll come on to talk about, leading ozone dry cleaning technology, which is the most effective in terms of killing bacteria and making sure that our users feel as safe as possible. And a large part of our job is kind of explaining to our users that renting is safe, that our processes are in place. And actually, we've had a great response in terms of the transparency that we've been able to provide the customers about how we operate as a business.
I assume this is just for the highest end of clothing, because you're looking to get what, like 10% of the retail price for a rental?
Yes, so we accept any items onto the Her platform that are over £120 RRP, so £120 retail value. So it's not just the high-end luxury £5,000 gowns that people think the rental's associated with. The large majority of our business operates at the kind of cooler contemporary end of the market, rather than those really luxury names. In the Selfridges rental collection that their in-house team have edited for this Project Earth initiative, there's a mix between really kind of contemporary contemporary brands all the way through to the more designer end of the spectrum. We want to kind of bring high fashion, fast fashion prices. That's the main driver for this project.
Yeah, Victoria, renting might make financial sense and also environmental sense. Is it having an impact, do you think, on the amount of clothing, the sheer volume of clothing that younger people are buying? Because that remains something of an issue for the fast fashion industry.
Of course, our user base is largely millennial, and what we want to try and do is stop the purchase of wear-it-once outfits. We're really calling for the industry to become more circular and more sustainable and fundamentally slow down. So what we're trying to do is extend the lifespan of the clothes that have already been purchased or already exist in this world, and get more uses out of those clothes through sharing them between people.
Where are you going to look for growth, Victoria?
So we're based in central London as a business at the moment, but we're scaling quite rapidly all across the UK. We're launching our second pop-up later this year up in Manchester. So we're really seeing huge viral growth from the back of our Selfridges announcement this week, which I think marks an excitement for the customer and gives the customer an alternative to the fast fashions, to the high streets of the world in a way that's affordable by giving them access to designer fashion. So for us, we really want to bring her to the UK-wide customer, and we'll be doing so later this year.
Thanks very much, Victoria. Really good to speak to you. Victoria Prue, the CEO of Her Collective. Thanks very much for joining us this Friday morning. We are 47 minutes into a trading session that's been fairly flat and slightly volatile this morning. Let's get a Bloomberg Business Flash for you. Here are today's top corporate stories. Pfizer and BioNTech say the COVID vaccine they're working on is on track for regulatory review in October. That timeline would make it one of the fastest moving vaccines in the world. The two pharma companies previously secured a deal to supply 100 million doses of the drug to the United States. Emirates has decided on its preferred mix of new Boeing wide-body planes. The carrier didn't provide details, but the focus will likely be on smaller aircraft rather than big jumbo jets. Negotiations are still ongoing about the timing of the deliveries. Emirates would prefer the smaller planes sooner rather than later. Bayer has agreed to pay $1.6 billion to resolve most of the US litigation over its now withdrawn eSure device. Some women said the contraceptive caused bleeding, pain, or failed to prevent pregnancies. The deal will resolve about 90% of the 39,000 lawsuits. The payout is considerably more than Bayer paid to acquire the company that made the device. That is your Bloomberg Business Flash. Matt?
All right, up next, commodities. From copper and gold to sugar and cocoa, the prices are soaring. That could paint a dark picture for the dollar, according to our MLive editor, Eddie Vanderveld. We'll discuss that next. This is Bloomberg. welcome back to Bloomberg Markets. This is the European Open. We are 51 minutes into the session, and we're looking at a slight loss on the FTSE right now, 0.1%, and slight gains on continental equity indexes. You can see the benchmark DAX in Frankfurt up 0.4%, the CAC 40 in Paris up 0.25%. Let's take a look at some of the individual movers. Adyen is one that's falling after executives sell shares at a price of $13.65. Right now, Adyen shares are down to $13.79. EasyJet climbing after the UK travel corridor with Portugal has been reopened. You can see those shares trading at $5.67 and Novartis at $79.09 after gaining U.S. FDA approval for Kesimpta for the treatment of relapsing forms of multiple sclerosis in adults. Anna?
Matt, so let's return to some market-moving stories. And joining us now for more of Bloomberg's Markets Live editor, Eddie van der Walt. And Eddie, good to speak to you. I want to ask you about what's going on in Europe at the moment. The euro dropped quite a bit, didn't it? 0.2% on the PMI data. It's clawed back some of those losses since. How weak was the data set we got out of Europe, do you think?
Look, I think the France numbers spook people a little bit, particularly the services numbers. Services numbers across the board have been fairly weak, both in France and in Germany, and that bodes, fairly poorly for Europe as a whole. Simply because if people aren't spending money, if people aren't getting out there and supporting restaurants and the rest of the services sector, that's gonna really hit Europe hard. Germany's manufacturing bringing things back a little bit, a fairly narrow beat there, but at least a beat on the expected reading in Germany.
We've been talking for a little while about the higher prices that we're seeing for copper, but really for commodities across the board, it would make you think that investors are betting on a global economic resurgence. But is it just that the dollar's falling?
Yeah, I think you've hit the nail on the head there. I think, commodities markets has been so interesting. We see this really big split. I like to look at the moment at the Bloomberg Commodity Index, excluding energy prices, because oil has been driven so much by what OPEC has done on the supply side. And if you strip that out and you just look at copper, gold, and at the agricultural commodities, then you see a very different picture. And we've seen those rally really hard from the lows. Copper, in fact, is trading at something like a 2-year high, or very near a 2-year high. Gold at multi-year highs. The fact that both of those commodities, one which is a cyclical commodity, and the other being a haven, the fact that they're both rallying tells me that people are not buying this on a sort of demand recovery, but are buying commodities more either on the expectation of inflation or on a weaker US dollar.
Let me ask you, Eddie, about the pound right now. 132 is where we trade, up 0.2% or so. We got retail sales numbers earlier, and also some debt figures from the UK government. What were your takeaways?
Right. Well, that big number, it's a big round number. Markets love big round numbers. £2 trillion is always a bit scary, and we had Sunak commenting to Bloomberg immediately afterwards. The pound, it feels like the pound is not quite done yet. Particularly because we may not have seen the dollar bottom out. Against the euro is a slightly different question. But of course, we've got some fairly big Brexit deadlines coming up, and the rhetoric has just been building up on that. So I think the pound is really at the precipice. But if I ask my colleagues on Markets Live, most of them are still bullish on the pound in the near term.
Most of them are still bullish on the pound. What are I wonder what the worst case scenarios are, because we keep hearing everyone's forecasts with a deal priced in, and I wonder what people think will happen if there isn't one.
Yeah, I think Europe, the Brexit situation, and Europe more generally, it's just become like the boy who cried wolf too many times. Every negotiation seems like crunch talks. Every time we think this is it, everything's going to break down, we're not going to get a deal this time, the whole of everything is going to collapse. And then right at the last minute, either we kick the can down the road, or we get a deal, or we just fudge things through. So I think that is what people are banking on. But that does set us up for a big disappointment if we don't see that coming through. If by December, Boris Johnson says, look, I am not going to extend, and we're not getting a deal, and I'm going to walk away, and we're going
yes,
on WTO deal, then that sets the pound up for significant downside.
okay. Eddie, thank you very much. Bloomberg's Markets Live editor, Eddie van der Walt, joining us there. That's it for the European Market Open. Surveillance is next. They'll take you through the latest on these markets. This is Bloomberg.
Biden vows to end the darkness. Democratic nominee Joe Biden calls his opponent a national embarrassment. He promises to support the working class and reform taxation. Tech continues to drive the rally. The Nasdaq hits a new record, propelling global equities higher. European stocks post modest gains. This as Pfizer says its vaccine is on track for regulatory review. And Angela Merkel says Europe should never return to another full-scale shutdown. The German chancellor says the costs are too great. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. This is what the markets are focusing on now. Partly they're focusing on what Angela Merkel said with Emmanuel Macron. That was yesterday. Partly they're also focusing on some of the data that just came out of the Eurozone. So let me go through the data, and let's also look at what impact that's having on the markets. So if you look at stocks here in Europe, they're really fluctuating after we had data from two biggest economies here in Europe, and that's really casting doubts on the region's recovery amid a resurgent in virus infections. If you look at euro, it's been weakening. We had French manufacturing unexpectedly contracting in August. We also had a gauge of German services actually falling, highlighting really the fragile state of the economy and maybe also highlighting the need for further stimulus. I'm also looking at offshore yuan rising to its strongest levels in 6 months, 7 months actually, during which China's economic and market rebound from the pandemic became one of the world's fastest. So this is what we're also getting in terms of PMI, certainly out of the Eurozone. They're pretty much in line with expectations, or certainly they're in line with what we were expecting. Euro area August services PMI falling to 50.1. Now, coming up later, everything you need to know about exchange-traded funds. ETF IQ Europe is at 9:30 a.m. London time. Yes, it's back. So we've been through the data. It is actually worse than expected. The forecast was 54.5. It came in at 50.1. Manufacturing PMI also worse than expected. Now let's get to the Bloomberg First Word News and the U.S. We start with the U.S. and Iran. It's handed the United Nations its demand to reinstate global sanctions against Iran. The Secretary of State, Mike Pompeo, is hitting out at European allies who oppose the move, accusing them of a failure to lead and of appeasing Tehran. Iran has pushed back, saying the U.S. is attempting to mislead the world. Former Trump advisor Steve Bannon has been released on bail after pleading not guilty to fraud charges. Well, prosecutors claim he laundered money as part of a border wall scam. They say he advertised "We Build the Wall" as a volunteer campaign while pocketing more than $1 million for personal expenses. Opposition activists in Russia say doctors are refusing to release anti-Putin campaigner Alexei Navalny for treatment abroad. The doctors say his condition is too unstable to travel. State news agency TASS reports he is still in a coma. A plane has already arrived to transport Navalny to Germany for medical treatment, while his team blame Vladimir Putin for his illness, saying he was poisoned. Hopes for a Brexit deal are fading. Little progress is being made on key obstacles to an agreement. Well, Bloomberg sources tell us that the British negotiators sought to break the deadlock. They submitted a draft free trade agreement based on what they saw as common ground with the EU. But so far, that hasn't led to a breakthrough. The latest round of talks wraps up today. And that's our First Word News. Now let's get on straight to our top story today. Joe Biden has accepted the Democratic nomination to challenge President Donald Trump. In his speech, he urged Americans to vote for a new national leadership that will overcome political divisions in the United States.
The current president has cloaked American darkness for much too long. Too much anger, too much fear, too much division. Here and now, I give you my word. If you entrust me with the presidency, I will draw on the best of us, not the worst. I will be an ally of the light, not the darkness. It's time for us, for we the people, to come together. And make no mistake, united we can and will overcome this season of darkness in America.
Well, joining us to talk about this and the impact on the markets is James Bevan, Chief Investment Officer at CCLA Investment Management. James, great to speak to you as always. Do the markets believe that Joe Biden will become president?
I think there is an increasing expectation. That's entirely what the market expects. But there is this very interesting toss-up whether the additional spending that Mr. Biden will certainly undertake, as per his manifesto, relative to the tax take that I suspect might take some $10 of S&P 500 corporate earnings.
So what do you think they'll focus on? Is it tax? Is it something else? It seems that a lot of the rhetoric now is why President Trump should not be, president for a second term. When do we actually latch on to the real policies of Joe Biden?
Well, I would say that there are 4 policies that I will be having under clear scrutiny. First is the tax policy. And as I say, I do believe it is likely to be worth around $10 for S&P 500 earnings in 2022 if fully implemented. Given that the consensus expectation is that index earnings will be about $165 next year, that's quite a big hit. Now, of course, those proposals may be watered down, and full implementation would require Mr. Biden not only to take the White House, but Democrats also to have control of Senate and the Congress. There is a risk, of course, that Mr. Biden takes the White House. The Republicans, however, can control the Senate, and therefore the capacity for him to implement his strategies may be quite limited. The second issue, which I think is very important, relates to his Made in America planning and the expectation that he will seek to drive the domestic economy, and that will be good news for domestic participants. The third issue is that he is just as hostile to China as is Mr. Trump, and therefore I do not see any material change in the Cold War that is such a big risk to global markets in terms of US-China relations. The final issue is Mr. Biden's absolute clear commitment to arresting climate change and investing in infrastructure. And I think this will be a huge support for companies like NextEra and other entities in the sustainable energy front. Really bad news for the fracking industry.
So, James, when you say that President Biden would be just as hostile to China as a President Trump, does it mean that the move that we've seen towards changing supply chains will continue and accelerate? And does that lead us to higher prices? Does it automatically lead us to inflation?
I think it certainly leads to a reorganization of supply chains, but the COVID-19 episode and lockdowns reminded everybody that many supply chains are fragile, and it's not smart to rely on having production from abroad if you have no control over that process. In terms of the possibility of inflation, I would say that one of the really interesting and important drivers of deflation over the last decade has been new technologies. And new technologies have the capacity to drive down prices by assisting productivity and enhancing processes and procedures, both for manufacturing but also for product specification. So it is not necessarily the case, but the disruption of globalization leads to a step shift up in inflation. The far bigger issue, which I think markets tend not to recognize, are the evolving demographics that are engulfing so many economies. So Japan, as we know, has a rapidly aging population and has now been mired in low, slow economic growth and almost no inflation for decades. I think Europe and China are following in the same direction in terms of their demographic pattern, and therefore both regions will have much slower growth than might generally have been expected. In contrast, the demographics in the States, I think, are much more propitious, much more supportive of continued growth, and therefore underpinning a continued overweight to the US equity market.
So your favorite in all asset classes is what, US equity markets going forward, and what's your least favorite?
Well, I would say stylistically, I am very much focused on quality and growth, and I am less concerned about which country I am investing in. So, for example, in terms of quality and growth, there is obviously the US information technology giants. But in Europe, for example, I would highlight Kering, which is a luxury goods company whose principal brand is Gucci. I think it's an extraordinarily good quality company. LVMH, another example of a fantastic European company, but just not in technology. If you were to say where are the areas which I think are most risky, although everyone talks about pharmaceuticals, I think European pharmaceuticals are relatively risky because their pricing discounts a return to European recession. And although the PMI, the Purchasing Manager Index numbers today were not strong, they are most certainly not consistent with a return to recession.
James, thank you so much. We'll have plenty more, of course, on your European assets. Interesting what you're saying about healthcare. James Bevan there from CCLA Investment Management. Coming up, Europe should work together to avoid another lockdown. Well, that's the message from the German Chancellor. She says the cost of closing down is just too much. We'll discuss that next with James Bevan. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash, and we start with Pfizer and BioNTech. Say their COVID vaccine, or the COVID vaccine they're working on, is on track for regulatory review in October. That timeline would make it one of the fast-moving vaccines in the world, while the two pharma companies previously secured a deal to supply 100 million doses of the drug to the U.S. Uber and Lyft have won a reprieve in the home state of California. A judge has ruled that the companies can keep operating as normal while challenging a previous order to comply with state labor laws. Well, the new rules mandates that companies treat their workers as employees, a move that would upend their business model. Bayer has agreed to pay $1.6 billion to resolve most of the U.S. litigation over its now withdrawn Issuer device. While some women said the contraceptive caused bleeding pain or failed to prevent pregnancies. The deal will resolve about 90% of the 39,000 lawsuits, while the payout is considerably more than Bayer paid to acquire the company that actually made the device. And that's the Bloomberg Business Flash. Now let's get on to Europe, and Angela Merkel has called on European leaders to work together to avoid further lockdowns. The German Chancellor made the comments during a visit to French President Emmanuel Macron. Now, she said that closing borders should be avoided at any cost. Meanwhile, this week's Brexit talks look set to end today without an agreement. Bloomberg understands that British negotiators submitted a draft free trade agreement, but so far that hasn't led to a breakthrough. So let's get back to James Bevan of CCLA to look at Europe and some things in the UK as well. James, thank you so much for sticking around. We were talking before about some of the things that you like and didn't like in the markets, and you preferred US equities to European ones. Do you worry about the UK leaving without a deal, and what kind of pressure would that put on European assets?
Oh, I think it's a terrible risk, and with quite a high probability. I had assumed that with the implosion of the UK Independence Party, which had been a thorn in the Johnson flesh after the election, that Mr. Johnson would go for an extension on the basis that he was always very hopeful to get a full agreement on the way forward done by the end of the calendar year. He seems absolutely adamant that he will have a deal or no deal in place by the end of the year, and therefore on January the 1st next year we will have whatever we have. And that, I think, is a huge risk for the economy, one that is actually far more damaging from my perspective for the UK economy, because we fired an awful lot of money at the COVID-19 crisis through Mr. Sunak's fiscal largesse. I would suggest that the next big move in the Eurozone is for there to be far more formal agreement on fiscal integrity across the arena, meaning that we can introduce for the first real time in Europe modern monetary theory, where the European Central Bank's activities actually fund government spending. I think we might observe that the commitment to buy in a further 1.3 trillion of government debt in the Eurozone, and the banks then committing to buy very roughly 650 billion euros, creates an awful lot of cash. But cash, whilst it denies the capacity for there to be a credit crunch, doesn't actually produce corporate cash flow. And we need corporate cash flow to get the sector moving forward, to therefore restore government revenues, also to drive expenditure on capital, and then to improve household confidence. So this shift, I think, in the political agenda for Europe from relying on the European Central Bank to emancipating government to spend more money, really important.
James, I have a headline on India, which I'll get to in a second. But first of all, today we found out that the UK government debt topped some £2 trillion for the first time ever. And going back to what you said about MMT, I mean, this is a theory that was really derided just, 10 years ago. What are the dangers of, the unintended consequences of actually doing MMT?
Well, MMT, modern monetary theory, is all about big government. It rests on the premise that government is better than the private sector at allocating resources and determining the preferred way forward for economies. And the aficionados of the theory welcome big government. And that's such a big difference from where we were a decade ago, when governments were embracing austerity, talking about shrinking the footprint of government and allowing the private sector to determine the allocation of resources. Now, this is, I think, much more an issue of politics rather than economics. The jury will be out as to whether or not modern monetary theory works. But I do think that there is a rising expectation that the medicine that central banks can provide for markets is now quite limited and is akin to pushing on a piece of string. In contrast, the government spending route can absolutely drive forward. The question is what happens when inflation accelerates, because the real text of modern monetary theory is that we will pull back government spending when inflation rises, because that would be the Keynesian approach. However, it is very clear that there are a number of academics now writing on modern monetary theory and saying, what the hell? We can carry on spending even when inflation is higher, because actually we think big government is a really important part of building a better society.
Yeah. So, James, we have that headline from India saying, so India is slapping new curbs on visas and schools to stem influence from China. I can't really make my mind up, what do you do with it as an investor? It seems that China may be a bit more marginalized in terms of influence, certainly when it comes to, US-China trade. Now, India taking a further step to curb that influence. Does it have any implications on the Chinese economy and therefore on investments?
I would say that the real issue for China is its dependency on dollar inflows to provide capital. I suspect that most people anticipate that China generates its own capital. In practice, there is a very strong flow from US quantitative easing by the Federal Reserve, typically via the French banks, sometimes via the Japanese banks, into China. And that has been a significant factor. Were there to be a reining in of that dollar availability, I think China's economy would weaken very quickly and represent a significant risk for investors. That said, some of China's tech companies, the Tencents, the Alibabas of the world, are global giants and do merit consideration for portfolios.
Do you see any value in some of the emerging markets? I mean, I don't know whether you have any exposure to it. Yesterday, we also had the Turkish Central Bank decision.
Francine, I am very absent or underweight exposure to emerging markets because I still believe that they have overborrowed in the US dollar, and I think that there is a risk that the US dollar rises again this year, the liquidity in the dollar begins to reduce, and that leaves emerging markets relatively restricted. I also anticipate that there is no reason to take on any additional risk when there are so many great opportunities in developed markets. I can still buy fantastic companies with high cash returns on invested capital, ample free cash flow, and therefore I don't feel the need to stretch for additional risk and the possibility of additional return, albeit in exchange for significantly higher risk.
Okay, so let's get back to what you like, which is U.S. equities. How many bankruptcies are we going to see in the U.S.? And does that make some of your equity holdings in the U.S. stronger, or do you worry about side effects?
I would say that we are likely to see a rising tide of bankruptcies in the States over time, but I would make two sub-points. One is that an awful lot of those bankruptcies are in the old energy sector. And we are absent the hydrocarbon complex on the basis that it is frying the planet as well as losing money. And on that basis is a very risky place to be invested. I would say that some of the second-line banks will also struggle, but that will only make the case for JP Morgan as a giant and a very effective operator even stronger than it is already. So JPM is a core holding in our US exposure. The other area, of course, are the smaller retailers because of the competition that they receive from the online players such as Amazon, and Amazon is also a core holding in our portfolios.
James, very quickly, actually, I love having you on because I always ask you things that during the week kind of got my little grey cells thinking because I wasn't sure exactly how.
We'll annoy him with this question.
We had a 30-year bond auction in 30-year bond auction in Germany negative. I mean, what's the reason behind that? Does that make sense?
From my perspective, these negative rates are an absolute reason why I would not be in the bond market. But actually, if one thinks about the corrosive implication of negative rates, it means that an aging population, as is the case with Germany, needs to save more to hit the capital they require for retirement. And the more negative you make these rates, interestingly, the higher the savings rate is moving in Germany. The same happened in Japan. And therefore, I would say the negative rates are absolutely not assisting economic recovery in core aging economies, and we ought to see a change, we ought to see a shift. Meanwhile, I think the German banking sector is uninvestable.
All right, thank you so much for the insight. James Bevan there, Chief Investment Officer at CCLA Investment Management. Now, let's get more on U.S. politics and the latest from New York. The U.S. Postmaster General, Louis DeJoy, is set to be questioned over 2 days on Capitol Hill. That's as he's become embroiled in a political fight between the Democrats and President Donald Trump over mail-in votes and the integrity of the November election. Well, we're delighted to be joined for more on this by Jennifer Zabazaja. She's our Bloomberg Quick Take reporter. Jen, always great to speak to you. I look forward to Fridays because of this. Why are the email service cutback, or the mail service cutbacks, so contentious, and how would they actually affect the election?
Yeah, so Francine, good to see you too. I don't know about you, but I feel like I've been saying Postmaster General more in the past 2 weeks than I have in years, in my whole entire life. But it's a really serious issue, mainly because President Trump, as you mentioned, has spent the past few weeks really trying to delegitimize voting by mail. And that's an issue for Democrats because this year, several Democratic voters have said that they are opting to vote by mail as opposed to voting in person. So the reason why this has really come into the spotlight is because Louis DeJoy's cost-cutting actions earlier this year delayed voting and getting mail to voters. And, you know, it's really leading up to the election. It's going to be an issue, and Democrats really don't want it to be an issue leading up to the election. So Democrats have spent the past few days during the DNC trying to reassure voters that voting by mail is safe. There is nothing wrong with it. They should trust it. But also, we're going to be paying very close attention to what DeJoy says over the next few days. Today, he is on Capitol Hill testifying in front of a House committee. And then Monday, he'll meet in front of a Senate committee. So it'll be really interesting to hear lawmakers press him on some of the decisions that he's made and how this could potentially impact voters and impact mail-in voting specifically leading into November. And just to note, you know, his testimony on Monday is something that President Trump is not very happy with. He actually tweeted and tagged Senate Majority Leader Mitch McConnell, asking him why the timing happens to coincide with the first day of the RNC. Francine?
Jennifer, the Republican convention, the Republican National Convention is next week. What are we expecting?
Yeah, so, you know, details are still sort of trickling in about what exactly we'll see at the RNC. Unlike the Democrats who opted for a virtual convention pretty early on, President Trump really was hoping to do something in person with crowds, which is what he's used to. But the speakers that we know for sure are going to be some up-and-coming Republicans like Nikki Haley and Senator Tim Scott. Also some unconventional choices like the Missouri couple that waved assault-style weapons at peaceful protesters earlier this summer that caused a lot of controversy. But separate from that, you know, President Trump is expected to make an appearance every single night of the convention and also expected to deliver his accept his re-election nomination at the White House, something that's been criticized on both sides. But, you know, I think we all have to remember that President Trump is a former TV producer, and he's been following what's been happening at the DNC very closely over the past few days, actually live tweeting a lot of the events. And so we can only expect that it's going to be quite different from what we saw this week. And, you know, I'm assuming that he's going to want to paint a very drastic contrast to what we heard from the Democrats about unity and about restoring democracy. Francine?
Jennifer, thanks so much for the update. Jennifer Zabazaja there, our Bloomberg Quick Take reporter. Now, coming up, it's back. It's August, but everything you need to know about exchange-traded funds. ETF IQ Europe up next. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Welcome to Bloomberg ETF IQ Europe. I'm Francine Lackwin. Over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Well, everything you need to know about the funds and the flows. Still shining, 8 of the 10 best-performing Europe-listed ETFs last week were focused on gold. We'll ask if bullion can keep on climbing. European ETFs crossed the $1 trillion mark for assets under management. Despite record highs for the U.S. stock market, equity inflows have underperformed fixed income. We'll ask why. And after a slow start, actively managed exchange-traded funds are taking off with more active launches this year than passive. We'll discuss how high they could fly. Well, good morning, everyone. Let's start the show focusing on gold. Of the top 10 best-performing exchange-traded funds in Europe last week, no fewer than 8 were gold-related. Now, the market access Gold Bugs ETF, which invests in companies involved in gold mining, rose more than 8% over the period. Despite that, gold holdings in ETFs backed by bullion snapped a 20-week streak of increases, registering a weekly drop. Joining us now to discuss all of this is Krishan Gopal. He is from the Market Intelligence Group at the World Gold Council. Krishan, great to have you on the program. So you also have a new ETF. What was, behind the decision?
So I think what we've seen in ETFs this year is tremendous interest, and that's been backed up by the inflows that we've seen. So we've seen a record level of about 900 tons to the middle of August, taking a total AUM in these products to around 3,800 tons. And this has really developed for over the last 15 or so years, and the kind of the environment that we're seeing currently has really highlighted the benefits that the gold can play. So we've seen 3 key drivers for the investment inflows that we've seen this year into these products. Firstly, we've seen the increasing need to hedge risk, the mounting expectations that the economic recovery is likely to be a U or a W shaped rather than a swifter V shaped. Speedy recovery is likely one that will create an added uncertainty over the coming months and years. And also the resilience in the equity market rally that we're seeing currently is posing questions for investors. The second key driver was the ultra-low interest rate environment that we've seen, concerted expansionary policy from both governments and central banks has really helped to lower interest rates, and that has brought down the opportunity cost of holding gold for investors, and also increased the potential role that gold can play as a future inflation hedge. And finally, it's also the price momentum that we've seen this year. So gold is around 30% up for the year, or just under that, and that itself has brought in added flows as we've continued to see the rally progress.
Krishan, is there anything, as too many gold ETFs?
Well, I think what we've seen around the world is that the demand that we've seen is actually led to more products, absolutely, and there has been increased competition. But at the moment, we continue to see demand outpace, new products, and we're continuing to see inflows, and I don't see that abating anytime soon. Yes, we will see added competition. We will see, costs go down, management fees will continue to be potentially competed. But at the moment, no, demand in gold ETFs is remaining strong, and the drivers that we've seen leading to those inflows so far this year look like they'll persist for some time yet.
Christian, if you look at flows in gold ETFs, do they tell us when you analyze them, do they tell us if people want to hold it, longer term or shorter term? And does that give us a sense of the risks that people perceive out there in the markets overall?
Absolutely. I think what we've seen in this year in particular with the inflows that we have seen is that there is a growing interest in a strategic holding to gold, not just a tactical one. And that's come over several months, and that's also due to the environment that we're seeing, as I mentioned, with the low interest rates, the kind of the heightened uncertainty, and question marks about the future and the kind of the length of any potential economic recovery. So I think, yes, we have seen investors kind of recognize the role that gold can play in this kind of environment, and not just at this moment, but potentially going forward as we kind of look to see how the kind of the impact of the coronavirus pandemic plays out, not just over the next several months, but potentially even longer.
How many of these funds are actually backed by physical gold?
So of the 80 or so funds that we track on our Gold Hub site, we look at those that are purely backed by physical gold. And normally that's in the region of anywhere between 90 and 100%. So the vast majority of these products are backed by physical gold.
If you look at the ETF gold markets, I mean, some would say that it just makes it a lot more volatile, the gold market more volatile. I mean, if we didn't have these ETF or gold ETFs, would the gold market actually look very different?
Well, I think it would look different in that it's an element of demand that wouldn't be there. I think what we've seen is actually the increased demand this year, and not just this year, but for a number of years, has actually meant that there is a kind of a demand for these type of products. I think they make it much more accessible to access the gold market, improve the ease at which people can come in and out, and actually add to the liquidity of the gold market. And again, as I said, the inflows that we've seen this year, around 900 tons globally, show that actually this is something that the market wants, and it's become a huge element of demand that we see on an annual basis.
Christian, when you look at, the gold is doing well at the expense of what other ETFs, and it's unclear to me, given who we speak to in terms of investors, whether the bulk of gold positioning is a protection against inflation or investors being afraid of deflationary pressures.
Well, our analysis has shown that actually gold will work in both situations. But what I think the question marks at the moment kind of suggest is that there's just a general lack of certainty around what may happen. Yes, absolutely, people are asking, rightly so, what does the future hold, given the expansionary monetary policy and the fiscal stimulus that we've seen could lead to, and the risk that may bring, and the ultra low interest rates I've already mentioned. So I think it's reasonable to think that this uncertainty has led to some of the flows that we've seen, not just in ETFs but in gold more broadly. And I think going forward, it's likely to be the case that this will persist for some time yet. We seem no closer to knowing the full outcome or the economic impact of the pandemic, and governments continue to adopt a relatively easy stance in order to support these economies. So for the time being, at least, it seems very much that the drivers that supported gold investment that we've seen in the first half of the year are likely to continue.
Christian, when you look at ETFs and positioning for the future, I don't know whether there's a technical lever for gold which actually would, mean a sell-off in ETFs. For those of us watching at home, or for those viewers watching at home trying to understand a little bit better the gold ETF market, are they supported by technical levels?
Well, we don't necessarily look at the gold price in that way. I think what we tend to look at is more the fundamental drivers, and as I've said, there are many which are kind of propelling this ETF investment that we've seen, particularly this year, the record levels of 900 tons so far. So I think the gold price is reflective of many of the drivers which have been driving the ETF demand, and there is a good reason why it is where it is.
Christian, thank you so much for joining us. We'll have plenty, of course, on gold. It's great. Actually, I was looking, I didn't know this, but I went on to the World Gold Council, and they have, global demand trends for Q2, and I think that's available to everyone. So that was our great guest looking at gold, and we'll have plenty more, of course, on gold throughout the day. We continue, of course, more on ETF. Coming up, active ETF launches look set to overtake passive launches this year for the first time ever. We'll discuss why investors might want to add active to their portfolios. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's discuss one of the biggest ETF trends of 2020, launches of active exchange-traded funds look set to overtake passive launches this year for the first time ever. In the US, the trend has been aided by a new SEC rule approving non-transparent wrappers, allowing stock-picking ETFs to keep some of their strategy private. Well, joining us now on the phone is Athanasios Psafarigis from Bloomberg Intelligence. Athanasios, thank you for joining us. Why the sudden interest in active ETFs this year?
Hi, Francine. Good morning. Sure. So one thing you just alluded to, I think there's two things. One is regulation, and the other is performance. And like you had mentioned, this new SEC rule has been fully implemented this year, and what it had done, it was started last year, but the biggest difference was that it treated active and passive ETFs similarly, and what it does is it makes active ETFs even more tax efficient than they were. And the other piece of regulation was this approval of non-transparent ETFs, and this was a big hindrance for a lot of the traditional active managers who wanted to jump into the ETF landscape because they were really reluctant to show their holdings. This new structure was approved, so you're seeing a really big uptick now in active launches, and in fact, you're seeing new participants jump into the market that weren't in here before. T. Rowe Price, Federated, DFA, these are all really big active shops in the U.S., and they're starting to jump in. And the other component is performance. if you look at the top performing ETF in the U.S. this year, it's an active fund. So I think the uptick in launches and the passing of regulation, coupled with the really strong performance this year, is drawing a lot of attention to the area, and I think that's why you're starting to see a pickup in flows in some of these big active ETFs.
So, Athanasios, what are some of the key reasons European investors might want to look at these?
Sure. So in the U.S., there is, to draw this parallel, there's a very big tax advantage to the ETF in the U.S. And this is even if you don't believe in active or you don't like the strategy, you already will gain because of the tax advantage. In Europe, this tax advantage is not really there, but there are other benefits, I think, to the U.S. and then, in Europe. And the volatility we saw in March, I think, really highlights this. And I think what's the important benefit of the ETF structure is it isolates activity from other shareholders. So what I mean is what we saw in March, we saw a lot of property funds, UK property funds, lock up. Why did they lock up? Because there was a lot of early redeemers in these funds, and they end up locking up anyone who's still left in the fund. What an ETF does is essentially it isolates the activity from the other shareholders. And I think this is really key. So if you want to get into a fund or get out of a fund, you're not impacting shareholders that are already in the fund. And the same thing with transaction costs. Every time a new creation or redemption comes into a mutual fund, they have to go out and buy the securities. That cost gets passed on to the shareholders. The ETF isolates that, and I think that is one thing to consider when looking at these active ETFs. Okay, sure, I don't have the tax efficiency, but I have more efficient and isolated way to get in and out of this fund without impacting other shareholders.
Athanasios, thank you so much for all of the update. Athanasios Psarophagis there from Bloomberg Intelligence. Up next, flowing into bonds, fixed income ETFs have taken in more than 3 times as much money during the S&P rally as equity funds. More on that next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, assets under management by ETFs listed in Europe have crossed the $1 trillion mark. Despite record highs for the U.S. stock market, though, equity inflows have underperformed. Since the March bottom, fixed income ETFs have actually taken in more than 3 times as much money during the S&P's rally as equity funds. Well, joining us on the phone is Andreas Zink, head of Switzerland and Liechtenstein managing officer at Vanguard. Andreas, great to speak to you. Thank you so much. Why this appetite? What will happen to active versus passive in the next 12 months?
Thank you, Francine, for having me. So I think the discussion active versus passive is kind of a discussion of the past. It's more a question of high versus low cost, and a lot of investors have actually realized that costs is the main driver of return. And they have decided to allocate more assets, be it active or passive, into low-cost vehicles, and that's actually why ETFs have benefited so much in the last 2 years with tremendous growth. You mentioned it, above 1 billion. That's the result, and the future looks bright. We think the growth will continue with about 15 to 20% per annum. So we could go as much as 2.5 up to 3 trillion, depending on the market performance, in 2025.
So, Andreas, if you look at some of the flows in ETFs, what are the big trends? Is it just that everyone's running into gold and kind of forgetting equity ETFs?
It's actually the trend discussion for once is a bit boring, I would say, because there are no new trends. The trends we are seeing, and you mentioned some of them, are old trends. So first and foremost, we have to mention fixed income ETFs. You mentioned it, the asset class in the fixed income market with the highest inflows dominated the market. A few years back, fixed income ETFs were not really relevant in the ETF market. It was pure equity and, to a certain extent, commodity game. This has completely changed, and we have seen massive inflows this year, potentially because the Fed and other central banks started to buy bonds and ETFs, fixed income ETFs. We have seen even higher growth. But for me, it's also kind of a good thing of Corona crisis is a bad thing, but a good thing of the Corona crisis is actually that ETFs, and in particular fixed income ETFs, could actually prove that they hold what they promise. And for me, ETFs are kind of heroes of the crisis because they delivered what they promised. There was always liquidity. It came with the price tag, which is very clear, but they actually delivered on the promise, and they were always tradable at reasonable costs, very transparent. So this is why we see so much more in fixed income ETFs. And the other trend I would like to mention is sustainable ETFs. It's incredible this year. You mentioned it, ETFs in equity, low flows, but sustainable ETFs are on a run. We have seen year to date about 17 billion inflows in that relatively new category.
Yeah, and I want to talk a bit more about ECG ETFs. Yeah, Andreas, you tell me it's boring, but then you tell me they're also the heroes of the market, so it's not boring at all. We'll get back to Andreas of Vanguard shortly. Now, let's look at, there's an ETF for that. Every week, we dig down into some of the big trends in exchange-traded funds. This week, here's Anne-Marie Hordern with, there's an ETF for that. Hi, Anne-Marie.
Good morning, Francine. Well, this week there's an ETF for that. We're looking at all of the stocks that are really exposed to the work from home sector. We are working from home, we're shopping online more, we're even socializing virtually, and we are seeing massive inflows into thematic. Thematic ETFs track gaming, internet, and cloud computing. And as you can see here, these really are starting to heat up in terms of these inflows. They are set to drive record inflows for the category, assets to more than $70 billion. And Bloomberg Intelligence says they expect issuers to keep introducing products that could eventually push thematic to the #2 size among ETF sectors. And so far for 2020, thematic ETFs had added $11.3 billion. So in this pace, we can really far outpace the 2017 record of 11.7 ETFs. And just quickly, Francine, if we dig into one of those specific topics, I want to show you cloud computing. This one ETF, Wisdom Tree Cloud Computing, computing fund. They have the names like Zoom, which pushed the NASDAQ 100 overnight into a fresh record. They also include DocuSign and Shopify. Look at it, absolutely just flying above the SPY. That's the S&P ETF, outperforming it. And we also see these massive inflows. So obviously, investors that don't want to just take on a specific exposure to one company, but want to get that work from home exposure are really flying into these ETFs.
Anne-Marie, thanks so much. Anne-Marie Horduran there with a full wrap-up of some of the trends there. Anne-Marie basically described my life. It's shopping online, staying at home, not going out. Let's get some final thoughts from our guest this week, Andreas Zing of Vanguard. Andreas, we were talking a little bit before about ESG. How much more, if you look at the European ETF market, it's definitely not as mature as the US market. Will the pandemic and what we've seen on the other asset classes mean that the European ETF market will mature more quickly?
I guess so. I think it's always difficult to compare Europe with the US because in the US there are several factors in play which are not relevant in Europe. For example, pension saving is a thing which people typically rely on the government and don't self-invest. So there is a lot to do in the European ETF market to bring it at the same level as in the US. But nevertheless, I think we see tremendous growth. We will continue to see tremendous growth because ETFs are just a fantastic instrument, and they make low-cost investing, they democratize low-cost investing, and everybody has access, so you don't depend on a distributor who kind of puts that ETF in your portfolio. You open a brokerage account, and you can buy those ETFs. Costs have come down. That's tremendous. But I think, as I said initially, it will take a few years to catch up with the US.
Andreas, very quickly in 20 seconds, what's most exciting out there? Is it ESGs or is it these trends on working from home that you can buy through ETFs?
Yeah, I mean, I was actually disappointed that you didn't pick a Vanguard ETF as an ETF of the week. No, I think what is really exciting, what excited me, as I said initially, in the Corona crisis, we had a perfect storm. Nothing was liquid except for two instruments. One was government bonds, and the other instrument was ETFs. And that excited me very much because everybody kind of was waiting for that perfect storm to happen, and everybody challenged us, the industry, whether ETFs are liquid in such a market environment. And they have delivered on the promise, and that excited me. And a lot of people have seen it, and they will shift assets from single lines, from actively managed funds, from other instruments, futures, for example, into this great instrument,
Andreas,
ETF.
Thank you so much. Andreas, thank you so much for your insight there from Vanguard. Well, that's it for Bloomberg ETF IQ Europe.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Biden vows to end the darkness. Democratic nominee Joe Biden calls his opponent a national embarrassment. He promises to support the working class and reform taxation. Tech continues to drive the rally. The Nasdaq hits a new record, propelling global equities higher. European stocks post modest gains. This as Pfizer says its vaccine is on track for regulatory review. And Angela Merkel says Europe should never return to another full-scale shutdown. The German chancellor says the costs are too great. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacroix in London, Tom Keene in New York. Tom, quite a lot of news out in terms of your area, GDP, actually manufacturing, PMI, not as good as expected. So that's kind of underlying the message from Angela Merkel and Emmanuel Macron that we had yesterday saying, you know, despite a resurgence of cases, they'll try and work together as a team to make sure that they can't go into full lockdown again so that a transfer of goods still happens between countries. And I thought that was a very important message because it will have an implication on markets.
And not in a usual summer Friday, folks. The news flow is absolutely extraordinary. We're going to get ourselves around what we're going to be doing with the Democrats now moving to the Republicans and the president, the usual convention cadence of August of an election year. But I'll tell you, Francine, that's not the headline item today. The headline item is 13 consecutive hours in our surveillance-thon. Francine Lacroix will be with us through the morning and through our simulcast as well. Francine, I'm really looking forward to it because the news flow, and for our American viewers in your early morning, this news of Merkel and Macron and the slowdown in France is not a small item, Francine.
Yeah, it's not. I'm also looking forward to our TV and radio marathon. If
it's a surveillance thon.
I don't know whether we'll have to like file for TV divorce afterwards.
No, we've already done that. The paperwork's in order. Yeah, I wouldn't know anything about that. I wouldn't know nothing about that.
Right. Which is why now we get along, right, Tom? Let's now get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine, Tom. Joe Biden slammed President Trump as a national embarrassment and vowed to end what he called the darkness. Biden accepted the Democratic nomination for president last night, and he said in his administration there would be immediate change.
The days of cozying up to dictators is over. Under President Biden, America will not turn a blind eye to Russian bounties on the heads of American soldiers. Nor will I put up with foreign interference in our most sacred democratic exercise, voting.
Biden also cited the coronavirus pandemic and said President Trump has failed in his most basic duty to protect Americans. President Trump warns that he'll impose tariffs on U.S. companies that refuse to move jobs back from overseas. At a campaign event in Pennsylvania, the president said that companies that do move jobs back would get tax credits. It's not clear if the White House is actually developing such a policy. House Speaker Nancy Pelosi is getting pressure from moderate Democrats running in swing states. They want her to reopen stimulus talks with Republicans. The so-called Blue Dog Coalition sees tomorrow's House vote on Postal Service funding as an opportunity to revive those negotiations. And pressure is growing on Hong Kong to reopen its economy. There's been a sustained decline in the number of coronavirus cases in the city, and business are pressing for restrictions on restaurants to be lifted quickly. Reports suggest that Hong Kong may not ease any restrictions until after a mass testing blitz next month. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom?
Some of the color there of the news flow of this Friday. It is extraordinary. On the data check, equities, bonds, currencies, commodities, it's a true churn to the market. We had an up, continuing the festivities of yesterday, and that ended abruptly in France with the economic data, and we've really reverted down to a lower yield regime, 1.37% on the 30-year, 0.64% on the 10-year. We quote our yield to 4 digits here at Bloomberg Surveillance. Gold, $19.40 the ounce off $6. That's really a headline statistic. And there's maybe the one statistic that matters, a negative 0.9907 on the tips. It really hasn't come into new lower real yields. It's indeterminate right now. Francine, I'd also mention George Saravelos at Deutsche Bank reaffirms get out of the euro, but he's not calling for weak dollar. He's calling for a churn here at the 118 level.
Yeah, Tom, I'm looking at European stocks. I mean, it was a great data check, as always, Tom, of course, but it is really important to look at some of the levels that you mentioned. European stocks are actually fluctuating. We did have data that really cast doubts on the region's recovery that came out of Germany and Europe. So the euro is weakening. I'm also looking at offshore yuan rising to its strongest level in 7 months, during which China's economic and market rebound from the pandemic became one of the world's fastest. But then you also have tensions between China and India. So there's a lot to talk about in terms of geopolitics maybe creeping into these markets. Joining us now to talk about all of this is James Athey. He's Aberdeen Standard Investments Director. James, thank you for joining us on this Friday. What do you do with European assets right now?
Morning, Francine. Yeah, I don't like them. I mean, I haven't liked them for some time because there are severe structural issues, and really the ability to mask those structural issues with cyclical strength has been something which we've seen maybe 1 year in the last 10 at least. And the environment we found ourselves in just a few weeks ago was one really where the market embraced this narrative that Europe had a quote-unquote good virus, and therefore it had a strong economic outlook, and the US quite the opposite. And to me, that really didn't make a whole huge amount of sense, first and foremost because controlling the virus, which seems to be the narrative now, is nigh on impossible, and to the extent that you can control the virus largely, that comes at the expense of economic activity. So to me, European equities really there is a secular sort of premium attached to them, or a discount I should say attached to them, because of some of the issues that the region faces. I certainly would not favour being heavily invested in Europe at all, and certainly not when the currency is as strong as it is at the moment.
James, you know what, Tom and I have been waiting to ask you this question practically all week. I think it was on Wednesday where Germany's longest maturity bonds, that's the 30-year, saw demand rise to an all-time high. And I think it was, also negative. How do you interpret that?
Yeah, it's a tough one. I mean, German auctions are often quite strange looking relative to others. The way in which the Buber manages that process means that you quite often get the appearance of failed auctions or uncovered auctions, but that's just the nature of the process. That doesn't really speak a huge amount to a lack of demand out there. If anything, the opposite has been true, where there's been a scarcity of high quality assets. But again, I think, duration in general is attractive. The yield that you are, receiving on owning that duration is not attractive, but return expectations across all markets are not attractive. And again, the European region, while we've had a couple of months where things have looked a little bit better, I think there are a large body of investors who, like myself, share significant concerns about where the medium-term trajectory is. To the extent that the medium-term trajectory is not negative, largely that will be because of or in concert with huge amounts of purchases from the ECB. And so I think it's just a combination of low growth expectations, low inflation expectations, demand for safety and duration in general. Why that happened this week, not so sure. But to me, this is just a sort of medium-term weakness and uncertainty story.
I love the medium term. It's such a British thing, folks. Okay, let me cut to the chase, James Anthony. I look here at the pandemic in Europe, and I really don't understand it. Into this weekend, we've clearly got Merkel and Macron driving the discussion, the discourse on the pandemic. How will the pandemic in Europe affect European revenue? I think we have a sense of that in America, but I don't in Europe. Do you just look at it as a blanket on revenue in Europe?
So it obviously depends which sectors you're looking at. I mean, in general, yes. I mean, this is a hugely disruptive and disturbing event on top of what was a not particularly healthy global economy and a very unhealthy European economy. So the starting point was bad. The starting point was being masked by policy and by debt. Underneath the hood, things were not healthy. And what we've seen here is a massive supply and demand shock. I think the demand shock dominates in the short term. If you look specifically at Germany and you look at a lot of its export sector, it has tended to be very sensitive to what goes on in China, and particularly the traditional sort of China stimulus, which is, big ticket items, infrastructure and investment. And what we're seeing is that China has kind of eschewed its attempts to stimulate the consumer in favor of going back to that tried and tested method. So that's probably good for some German exporters. That's probably good for the German manufacturing sector in general. But across the rest of the region, anything which is related to consumer services, anything which is virus sensitive, I think things are not good. The only sector really that we're seeing globally and specifically in the US that seems to be benefiting in dramatic size is tech, and Europe doesn't have a huge amount of tech stocks there.
This is really profound. I brought this up a couple days ago over a cocktail conversation, James, but to me it's absolutely profound. If you adjust America for tech, is there an equivalency to everything else in America with Europe or not? Is America outperforming ex-tech Europe?
Basically, no. Basically, if you strip out a handful of companies, really, the sector in general, and look at the trajectory of those equity markets, you see the MSCI World excluding the US. If you see the US excluding tech, what you get is a reasonably consistent picture.
James Anthony, thank you so much. Greatly appreciated as well. Lots going on around the world today. Of course, we'll have a great coverage on American politics, its effect on the markets. But there's a story that has been developing for 24 hours, and this is in Russia. Francine, help me out here. This gentleman is the opposition to Mr. Putin. And Francine, as you saw in the south of London here 2 years ago, poison is at hand for the Russians, isn't it?
Yeah, so for the moment, Tom, we don't exactly know, or nothing's been confirmed, but certainly according to the spokesperson of Mr. Navalny, who's currently in a coma in Omsk, this was poisoning. Now, he started to feel unwell, we understand, while on a return flight to Moscow from the Siberian city of Tomsk, and then made an urgent landing in Omsk. So we're looking at live pictures of the hospital where he is in Omsk. I understand that the Germans also sent a plane to actually take him to Germany for treatment, but the doctors in Omsk say he's too unwell to send to Germany. So it's a developing story that could have huge repercussions, in foreign policy.
Right, some 1,400 miles. This is southeast of Moscow and southwestern Siberia. Coming up, Noah Rubini of NYU. Stay with us through the morning. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Bloomberg surveillance from London, from New York, not a usual August Friday. The news flow is extraordinary, including grim France news on economic growth, a real setback there that did move the markets to an ebb as well. And of course, we've got all the politics in America to reveal. Kevin Cirilli will join us later. Also, Jeannie Triano will join us as well. James Athey with us right now, Aberdeen Standard Investments, as we look at the opportunities out there and what to avoid. Let's start with that. First, do no harm. James Athey, what's the number one thing I not want to do into Q3, Q4?
Oh, wow, what a great question, Tom. I mean, I keep expressing my concern towards risky assets in general, equities specifically, credit specifically, and obviously that continues to be wrong. I think it would be the biggest thing to avoid would be the classic age-old problem of assuming that the future looks like the past, extrapolating the trends that we've seen since March and believing that they will go on to forever or continue at least for the medium-term future purely because, not a lot changes with respect to growth, virus, and central banks. I don't think that's necessarily going to be the case in the coming months. So I continue to believe that diversification is quite difficult because the influences driving markets are so consistently the same and it's so consistently about policy. But I do think things like precious metals and FX can be good diversifiers. So I'd certainly want to have exposures in some risk-off type positions in markets such as those.
Well, this is a question through the week, James, and to me it's so important, folks. This is, do you diversify through individual security selection or do you diversify through sectors? And then as Mr. Athey says there, do you diversify across other assets as well, tangible and intangible? Do you do a sector diversification, James, or do you really have to go down to a greater ownership of individual securities?
Yeah, I think that's a good question. I mean, if you kind of go back to the theory and break down the drivers of an individual stock, you'll probably find that the idiosyncratic drivers are small relative to the beta to the overall market and the correlation with the broad sector. So there is some information there. You're not going to find a huge amount of assets which have predominantly idiosyncratic drivers and therefore truly do give you diversification in huge size relative to their sector or to their beta. I certainly think is something which I think is becoming entrenched as an investor psychology is eschewing the concept of value. Now, I understand value is somewhat charged because it's an investment style in itself, and we all think sort of Warren Buffett and Dodd and Graham. But to me, not understanding what it is that you're paying for today in terms of expected revenue streams and where the symmetry or asymmetry lies around expected returns given the price that you pay today is as big, if not a bigger input put into trying to sort of gauge which sectors may do well and may do badly out of a situation that we face today. So yes, of course, we can say that tech should be able to benefit. People are going to work more remotely, communicate more remotely, shop remotely, etc., etc. But that doesn't mean that today's price is justified. And I think that's where the prevailing environment for investors just seems to be to forget about the idea of value or price or what it exactly is you're paying for, and just attach to fairly high-level narratives about how the world is changing.
James, you've been with us for like 16 minutes and we haven't even talked about Brexit. So we understand it's not really going to plan, but, for the moment, or that there's a kind of, the free trade agreement is on the cards. I think we're expecting some kind of press conference by Michel Barnier shortly. But what do you do with guilt?
I would have been quite happy to not talk about Brexit, to be honest, Francine. I've enjoyed a period where there's been plenty of other stuff to get our teeth into. What do you do with guilt? We're short. I'm a bit less short as of today than I was a few days ago, just because we have seen a small pop in yields in general, and gilts have participated in that. I think essentially gilts look quite expensive in their own market relative to the cash rate, relative to inflation. I mean, break-evens, 5-year break-evens at 3.5% or there or thereabouts, and you've got 10-year gilt yields at 20 basis points. Something about that is not quite right in my mind. So I favour sort of underweight gilts relative to other markets, but really that's not. There's no Brexit story in there really for me at the moment. Sterling, I think, is still where you probably want to express a view on Brexit, and so I've been somewhat surprised by how well sterling continues to do, notwithstanding that the dollar's done most of the heavy lifting. Sterling has continued to perform pretty well at a time where, as you say, it doesn't look like things are necessarily going according to plan with respect to the negotiations and our future relationship. And in the past, prior to the virus, that has been catastrophic for sterling. So cautiously, we're a little bit short sterling, just expecting the second half of the year will be somewhat different.
James, Michel Barnier is talking right now, briefing reporters over in Brussels, saying that he's disappointed with progress on the talks. I mean, away from Brexit, are we going to see MMT in the UK?
Well, will they call it MMT? No, I don't think so. You get into some real subtle theoretical distinctions, really, about what's MMT, what is monetization, and what just happens to be two independent bodies acting at the same time, given the same inputs and influences, and coming out with a result which looks like MMT. I guess whatever the central bank is buying bonds in the way that it has done throughout this, and that's something akin to QE or large-scale asset purchases, and not giving money directly to the government, the argument will continue to be that this is not MMT, this is not monetary financing. And I don't think that's a line really that anybody who's currently in situ in the UK institutions wants to cross. So no, I don't think we'll get there explicitly, but if the government continues to put money into the economy at the pace that it has been, it could well be that the outcomes would match what you might expect under an MMT policy.
James, thank you so much for joining us today. James Athey, their Aberdeen Standard Investments Director. Now, later today, we'll be speaking to Christopher Eilman. He's a CalSTRS Chief Investment Officer. It'll be interesting to get his take on treasuries and where you look for yield. That's at 3:30 p.m. in New York. That's 8:30 p.m. in London. And this is Bloomberg.
you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get your Bloomberg Business Flash. Pfizer and BioNTech say the coronavirus vaccine they're developing is on track for regulatory review in October. The two companies released more data from an early-stage study. They say the vaccine was well tolerated with mild to moderate fever in fewer than 20% of the participants. Bloomberg's learned that the Federal Trade Commission questioned Facebook CEO Mark Zuckerberg over 2 days this week. It was part of an antitrust investigation into the social network. The FTC, the Justice Department, and state attorneys generals are looking into Facebook's market power and influence. That's your Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. Now, the EU chief negotiator for Brexit, Michel Barnier, is briefing reporters in Brussels. This follows the seventh round of negotiations with the UK. He says he is disappointed with the outcome, but they still have 2 months to find an agreement. Of course, we were trying to get from both sides. He says, again, he took note of the UK decision not to, extend a transition. And this was, Tom, the biggest question, whether the UK at the end of the day, the 11th hour, decided to extend, or whether they'd rather go to a WTO agreement come January 1st, 2021. Coming up next, we talk about the DNC with Peter Trubowitz, a London School of Economics professor of international relations. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
president has cloaked American darkness for much too long. I'll be an ally of the light, not the darkness. As president, the first step I will take will be to get control of the virus that has ruined so many lives. Because I understand something this president hasn't from the beginning. Will we be the generation that finally wipes out the stain of racism from our national character? I believe we're up to it. I believe we're ready. But it's long past time the wealthiest people and the biggest corporations in this country paid their fair share. We can and we will deal with climate change. It's not only a crisis, it's an enormous opportunity. An opportunity for America to lead the world in clean energy. The days of cozying up to dictators is over. And make no mistake, united we can and will overcome this season of darkness in America.
Well, that was the Democratic nominee Joe Biden addressing the nation at the DNC. Joining us now is Pete Trubowitz. He's LSE Professor of International Relations. Peter, good morning to you. One of the things that we're trying to figure out in my newsroom at home this morning is this is basically about President Trump. They're making it about, President Trump has done a terrible job, and so you need to choose something else. If the messaging is too negative, could it backfire for the Democrats?
Yeah, I'm there.
But I think that attacking Trump's competence is smart for Democrats for two reasons. First, it's Donald Trump's biggest liability going into the election in November. And it is a surefire way to get Trump's goat, and it did. My guess is he spent more time this past week attacking the Democrats than meeting advisors about the pandemic. And that might not matter to Trump's base, but there's a lot of suburban voters, white, college-educated suburban voters who basically have become tired by and frustrated with Trump's shtick. And so I think the Democrats concentrated on that. They hammered it. Michelle Obama started it off on Monday night, and I thought Biden, rounded it out last night. And I think that's probably one of the most effective arguments they can make.
But, Peter, what should be the strategy of the Democrats if they want to win in November? Is it turning people who, voted Democrats and then voted for President Trump back into voting Democrats? Or is it just a turnout? Do they need to focus on people that haven't voted in, 4 years, 8 years, 12 years to go to the polls or to vote by post?
Well, personally, I think the biggest thing for the Democrats is to unify their own base before they start trying to reach out for those, voters that are, and there's very few of them at this point, that are undecided. And I think they did that during this convention. I mean, we're going to have to wait and see. This is totally new, an online convention and so forth, but they needed to rally the troops. And I think my sense is they energized and inspired the base. And so I think that's job number one. I think they're going to have to figure out also whether or not I think they're going to start encouraging their own voters to find a way to actually vote physically, to go to early polling places, to mailbox drop-ins, and not to just rely on mail-in ballots. I think we'll hear more of that in the coming days.
Peter Trubowitz, Tom Keene in New York, thrilled to have you with us today. You have a book out 9 years ago, Politics and Strategy, which is absolutely must read. And in it, you've got an extremely important chapter on Herbert Hoover and the others of strategic retrenchment. Do you just anticipate that President Trump will retrench around his comfortable majority?
Yeah, so that argument was about presidents, of course, Tom, that retrench internationally, which is frankly what I think Donald Trump has done. But I do think, yes. So, look, Trump's strategy is to play to his base. They believe, that is, he and his team believe that there are Trump voters who did not vote in 2016, these are white blue-collar voters who they somebody who can be brought out and in the key swing states. That's what he's doing. That's the strategy.
Right.
You know, I think it's a high-risk strategy because it's like trying to pull an inside straight, to use that phrase, a second time. But he did pull it off one time in 2016.
But Peter, what's so important here is a definition of the 2020 silent majority. How does Vice President Biden not do strategic retrenchment, and how does he reach out to that silent majority?
Well, I think that we saw some of that last night. You know, I will say that I thought Biden beat expectations with that speech last night. And I think, you know, to use Donald Trump's words, he looked strong. He came across as focused, energetic, and passionate. But I thought the most effective, this goes to your question, the most effective parts of the speech were when Biden spoke from the heart, and like at a minute 11, where he talked to people who had, this is really talking to older Americans and people who had lost a loved one to COVID, and he told them he understood loss. He also understood or learned how to overcome loss. It was very moving, and I think for a lot of voters, or you know, the kind of voter you're talking about, I think he sharpened the contrast between himself and Trump, who has difficulty showing empathy for people, and I think those are the voters that you're talking about, and so, you know, it's hard to know who this online convention reached. And that will be the same for the Republican convention next week. But I think along the lines you're talking about, he helped himself.
All right, Peter, thanks so much. Peter Trubowitz, there, LSE professor of international relations. I'm looking at my screen just to look at where pound is. So first of all, I don't think it's moving that much, and certainly the FTSE 100 hasn't moved, Tom, but we did have some significant headlines from Michel Barnier and his counterpart, Mr. Frost. So they have been, trying to negotiate a deal before that deadline. That is the end of the year. Otherwise, the UK will resort to WTO trading rules with Europe. Barnier really not mincing his disappointment that talks haven't gone to plan. He says an agreement at this stage with the UK seems unlikely, and Mr. Frost, for his side, on the UK side, says time is short for both sides.
And Francine, what's so important here, folks, is the overlay of Brexit. And I remember John Farrow sitting out on the set the morning after in shock. Francine, the overlay of the pandemic now with Brexit is just extraordinary.
It is extraordinary because if you look at, debt in the UK, so this is one of, I guess, the concern that people were taking a bet on. If you look at what we heard in terms of, it has, this country, the UK, has the highest debt level it's ever had. And so there was a bet in the markets, I think, that because of that, the UK government wouldn't feel that it could leave the EU without a trade agreement. So there was maybe a feeling out there that because they were already spending so much money in COVID-19, they couldn't spend, that much more money in mitigating the effects of leaving under WTO rules. But they just haven't made progress so far. It doesn't mean that they won't, Tom. There's still 2 months. But, Mr. Barnier looking pretty downbeat. Pound 131.61. Now let's get straight to the Bloomberg First World News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Joe Biden accused President Trump of failing in his most basic duty to protect Americans. Last night, Biden accepted the Democratic nomination for president, and he made it clear what a Biden administration would tackle first.
As president, the first step I will take will be to get control of the virus that has ruined so many lives. Because I understand something this president hasn't from the beginning. We will never get our economy back on track. We will never get our kids safely back in schools. We'll never have our lives back until we deal with this virus.
Biden also said the U.S. doesn't need a tax code that rewards wealth more than it rewards work. He says it's time for the biggest corporations to pay their fair share. Secretary of State Mike Pompeo has formally demanded that the United Nations reinstate global sanctions against Iran. Pompeo also slammed European allies who opposed the move. He accused them of a failure to lead and of appeasing the Iranian regime. And President Trump says this will be the most fraudulent election in history. The president told Fox News, quote, "They're trying to steal the election." He said that mail-in voting will lead to widespread cheating, even though there's been no evidence of that in previous elections. Former Trump campaign guru Steve Bannon is free on a $5 million bond. Bannon has pleaded not guilty to charges he conspired to commit fraud and launder money whilst raising funds for a border wall. Prosecutors say the former White House chief strategist defrauded hundreds of thousands of donors. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Let us not forget our place in history in this fiscal buildup that we've seen, it seems, in each and every country. Coming up, Robert Skidelsky, of course, Lord Skidelsky of Warwick University. Lord Skidelsky on our fiscal state of affairs. Somehow, I think we will speak to Skidelsky of the path forward to economic growth. This is Bloomberg. Stay with us.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Bloomberg Surveillance. Good morning, everyone. We're having a surveillance-thon today. Francine Lacroix and Tom Keene to get you through the morning, a late morning, I should say, in London, and through all of the morning in the United States. Thrilled to give you many hours of our perspective from, I should say, across the Atlantic as well. Right now, a joy. Robert Skidelsky is controversial. He's a definitive historian. Of course, his work on Maynard Keynes is absolutely across generations definitive, but also Skidelsky is someone who criticizes conservatives and labor with equal fervor, and we're thrilled that Lord Skidelsky could join us this morning. I don't think in your 3-volume on Keynes there was the magnitude of fiscal debt and deficit that we have now. What do we do about the magnitude of the debt?
Well, there was really, if you think of the debt incurred in the First World War. I mean, that was absolutely huge. Well, I mean, 200 or 250% of gross domestic product. So that was sort of comparable to what we're seeing today. And the way they got out of it was through the growth of the economy eventually. It's the only way really to reduce the net burden of debt is the economy has to grow.
Right.
And you've got to have policies to make it grow, help it grow.
Lord Skidelsky, one of the charms of your work is short term is 10 years. Politicians can't work the Skidelsky timeline. Politicians are worried about 2 years, 4 years, 6 years, maybe at the most 8 years. How do politicians extend their timeline to get to where they trust that growth will work out these huge debts?
Well, I think the first thing is, I believe the problem is what you do in the next 12 months. So in that sense, I'm quite short-term about this. I mean, we're going to have a recession. We're going to have a deep recession. It's not unexpected event coming out of a clear blue sky. Everyone is forecasting it. It's just the doubt is about the extent to which the economy is going to slide. In the UK, they think it'll be, about, 13, 14, 15%. Smaller economy and with comparable unemployment. Perhaps in some countries it'll be less, but we're going to have a slide, and it's coming like a blackening cloud. And the question is, what are governments proposing to do about it? That's quite apart from the fact that we might get other waves of COVID, smaller waves. But what's the policy? And the cupboard seems to be a bit bare. I mean, it's sort of ambulance work now. We're keeping a lot of people. We're keeping the pay up of a lot of people who are not working, and we're paying businesses not to produce. How are we going to get beyond that?
Lord Skidelsky, what should the UK government do in terms of furloughs? So far they've rejected, the asking or the extension of it, and that's a bit different to what Germany and France are looking at. Should they extend?
Well, it's the awful problem with economics. People, if they take their model seriously, they will put their bets on a V-shaped recovery, so that as industry gradually reopens, so people will get back to their jobs in a reasonable way, and we'll have a quick return to normal. But it's not going to happen like that. There's a lot of industries have actually been forced to close down, and then the conditions under which they can continue are very, very restricted. So you have this supply shock, and then gradually demand will fall as the furlough is ended. Now, I mean, I think you can say, okay, let's extend income support for people, but you can't pay masses of people for not working forever. It's not that you run out of money. I'm not so worried about the debt, but you run out of wealth. The economy is shrinking, money supply is growing, and then you get just inflation, and the money is worth less and less, and the society gets poorer and poorer. So you've got to actually create work. You've got to do something. Government has to spend, provide work. And I believe it's got to start big public work schemes, just as Roosevelt did in the 1930s.
Robert, thank you so much. Lord Skidelsky there, UK House of Lords crossbench peer and Warwick University Professor Emeritus of Political Economy. Lord Skidelsky stays with us, and we'll talk a lot more about some of these fiscal programs. Now, coming up, Jonathan Golub, Credit Suisse Chief U.S. Equities Strategist. That's at 7 a.m. in New York. That's 12 p.m. in London. And this is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we're having a great conversation with Lord Skidelsky, UK House of Lords Crossbench Peer and Warwick University Emeritus Professor of Political Science. Lord Skidelsky, we're talking a bit about, what governments need to do to help with displaced workers. Now, you've called for a jobs guarantee program. What's the merit of this? A lot of people in politics, think this would just be too difficult. Who can you convince about this being the right thing to do?
Well, I think I think you've got to start with just the idea of public works. That was a classical not remedy for depression. It was classical compensation for loss of private sector jobs. Governments provided public works, and you just have to look at all the things that could be done at a local level as well as particularly at a local level, and to be convinced that it's not just a matter of just sweeping up leaves or filling up holes and digging them up again. Keynes had an off the cuff remark. He said, "Look, if you had people digging up holes and filling them up again, then need be no more unemployment." But that was a joke. He added, "If you can't think of anything more sensible to do." And of course, there are lots of more sensible things to do. Roosevelt found them in the civilian conservation work program administration. Millions and millions of jobs doing good things in the United States in the 1930s.
Lord Skidelsky, I have been thunderstruck about the lack of study over the last 6 months or so on any kind of wage disinflation or outright wage deflation. Daniel Yergin opens Commanding Heights, his iconic one volume, with Clement Attlee struggling with the wage of the United Kingdom. Are we out of our minds that we're not studying the risk of true wage deflation?
Well, no. Well, of course we should be studying wage deflation. But you have this economic orthodoxy, don't you, that if you have flexible wages, you will maintain full employment. I mean, that is the model that is accepted by most economists.
Well, but this is really important. I don't mean to interrupt, Lord Skidelsky, but someone as opposite of Robert Skidelsky as John B. Taylor of Stanford will agree with you that sticky wages is an assumption. Is it?
Yeah, well, it's a perfectly reasonable assumption. Wages aren't like water or fluid things that sort of instantly adjust to whatever whatever the conditions are. They do stick, and in fact, that is why you do get depressions when you have a shock. You don't get wage adjustment, and what you get is an increase in unemployment, and then that feeds on itself, and the economy runs down. I mean, that's what Keynes said. That's what our experience is. Therefore, it's no good relying on the automatic forces of the market to bring about a very rapid recovery from shocks. I read many economists who expect a V-shaped recovery, and the instrument they rely on is flexible wages and prices. Mm-hmm. And that just seems to be the wrong model. It's wrong theoretically. It doesn't happen that way.
So Lord Skidelsky, theoretically, what kind of recovery are you expecting us to see?
Theoretically, what kind of, what am I expecting? Sorry, I didn't get
recovery.
That. Yeah, well, I'm expecting...
What kind of recovery?
What is called a U-shaped recovery. I think there'll be a long period, if, given that there isn't policy, given the policy, I think there'll be a period when we have very high rates of unemployment and the economy is smaller. Eventually, in the long run, yeah, there'll be a return to normal. But what sort of normal will it be? Will it be the same normal as we had before? Or will work habits change? What will happen to the inner cities? One of the problems is that a service economy is very, very vulnerable to the cessation of business. And we have predominantly service economies in the UK, and they're being prevented from working because people have been prevented from using services.
Robert Skidelsky, we are out of time. Thank you so much, Lord Skidelsky, of course, the author of the classic 3 volumes on Maynard Keynes. Churn to the market. It's a Friday churn. Sterling, Skidelsky driving sterling weaker, 131.68. It's a surveillance-thon. Noy Robini with Francine Lacroix and Tom Keene. We do that next. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This morning, an ebb to Friday optimism as France considers a slowing economy, as well tourism. It returns, and with it a surge in the pandemic. Merkel and Macron, they meet, they are masked. Can they link Postal Service salvation with more stimulus? Moderate Democrats, they insist. And it is decidedly not morning in America. Vice President Biden says President Trump has, quote, failed to protect us. There is, quote, too much anger. Biden says we are in a season of darkness. Good morning, everyone. This is Bloomberg Surveillance from New York, from London as well. Francine Lacroix and Tom Keene. It is a surveillance-thon Abramowitz off, Farrow off, Lacroix to the rescue. 5, 6, 7, 8 hours with Francine Lacroix today. That is bliss. Francine on France. I like that. It's poetic. Francine on France. It was truly a shock to see the slowdown in the French economic data.
Yeah, it was. I mean, if you look at the numbers, Tom, it really missed estimates. And it was interesting yesterday when Angela Merkel met with Emmanuel Macron that they seem to have a united front in saying they will do whatever they can to keep the economy open. Now, it doesn't mean that they won't put, more measures. But if you look at the number of infected with COVID-19 rising in Germany and France, it's a real problem with, for a lot of these leaders. What do? Do you go back into lockdown? They seem to suggest that with more targeting measures, they don't want to go back into lockdown. And it was interesting, they especially spoke about borders, that if they can, they don't want to close borders like we were in the Great Lockdown.
Well, a debate in America, too. Maybe the border between Florida and New York would be one of the selected borders of debate. On a Friday, an extraordinary Friday, with our first read news in New York City, here's Ritika Gupta.
Good morning, Tom, Francine. Joe Biden slammed President Trump as a national embarrassment and vowed to end what he called the darkness. Biden accepted the Democratic nomination for president last night, and he said in his administration there would be immediate change.
The days of cozying up to dictators is over. Under President Biden, America will not turn a blind eye to Russian bounties on the heads of American soldiers. Nor will I put up with foreign interference in our most sacred democratic exercise, voting.
Biden also cited the coronavirus pandemic and said President Trump has failed in his most basic duty to protect Americans. President Trump warns that he'll impose tariffs on U.S. companies that refuse to move jobs back from overseas. At a campaign event in Pennsylvania, the president said that companies that do move jobs back would get tax credits. It's not clear if the White House is actually developing such a policy. House Speaker Nancy Pelosi is getting pressure from moderate Democrats running in swing states. They want her to reopen stimulus talks with Republicans. The so-called Blue Dog Coalition sees tomorrow's House vote on Postal Service funding as an opportunity to revive those negotiations. And pressure is growing on Hong Kong to reopen its economy. There's been a sustained decline in the number of coronavirus cases in the city, and business are pressing for restrictions on restaurants to be lifted quickly. Reports suggest that Hong Kong may not ease any restrictions till after a mass testing blitz next month. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Let me do the data now. I want to do this very quickly on a Friday because there is a churn to the data. Yields come in 1.37%, 30-year bond. That tips everybody's falling. The real yield, negative 0.99%. Francine?
Yeah, Tom, European stocks are actually fluctuating. Again, if you look at, full faith in technology-led rally, challenged by poor economic data from the Euro region. You mentioned France, PMI is really significantly falling estimates, but also Germany was disappointing. So I'm looking at the Euro go down a touch, and then if you look at the offshore yuan, rising to the strongest level in 7 months against the dollar. China's economic and market rebound from the pandemic was actually one of the fastest in the world. So keep an eye on China and what they'll do next.
We can go many ways here in a 3-hour conversation with Kevin Cirilli. Unfortunately, we only have minutes here. And what I want to do with our chief Washington correspondent is drive forward the conversation. But first, last night, Vice President Biden.
As president, the first step I will take will be to get control of the virus that has ruined so many lives. Because I understand something this president hasn't from the beginning. We will never get our economy back on track. We will never get our kids safely back in schools. We'll never have our lives back until we deal with this virus.
Vice President Biden last night with a decidedly dark speech is what was making the headlines. Kevin, I don't want to do a postmortem. I want to look forward and get ready for next Republican week. The president, I believe, on August 27 is speaking at the White House. First of all, can you have a convention on federal property?
Well, they're going to, yeah, they have to. I mean, look, I think that the speech that he's going to give next week is going to be very different than the speech that Joe Biden gave last night. And I also would argue that in the lead up to it, the Republicans have had the advantage to look at what went well, what didn't work with the Democrats, and they're going to be able to kind of sort through that. But they're really going to focus on heartland voters. They're going to have some speakers that represent the heartland, I'm told. And they're also going to feature predominantly this issue of law and order, not just in terms of the protests that have rocked the country over the past couple of months, but also on the Supreme Court. I think next week a key theme, based upon the conversations I'm having, Tom, with folks on the re-election campaign, is going to be the Supreme Court and that Brett Kavanaugh vote, which I think you're going to hear a lot more about next week.
I mean, absolutely thundering, Kevin, to see the darkness last night, the idea that the president failed, what President Obama said a few days ago. Does President Trump go back to morning in America?
You know, I think that behind the scenes, there are two policy points that I would make on that. First and foremost, I think you're going to hear a lot about the economy because they feel that that's an issue that they can take head on to the Biden campaign. And secondly, I think you're also going to hear a little more brevity, so to speak, because I think that is the thread, Tom, that you just mentioned, that Republicans were very curious about. Typically, they would have anticipated a much more uplifting tone, but, you know, I think that the pandemic does, you know, these challenging times.
Kevin, how difficult is it to actually measure the impact of these conventions? I mean, it must be easier because it's online, but so do we think that it's swaying less voters than in the past?
You know, we were crunching the numbers on this all throughout the week, and if you look at the ratings, Francine, they've really been trending downward in terms of the number of people that are actually watching, and it's 20% percentage points down drop. Typically, there's anything like 26+ million people that tune in per night on the conventions. Back in the McCain Obama campaign, it was something like 35 million plus per night on the conventions. So this go around, it's been hovering between 18 to 22 million viewers per night. We don't have the data for last night. But the digital side, that's where it gets really interesting because that's tripled according to the DNC data. It had typically in 2016 been about 10 million digital streams of people tuning in. Now it's something like 28 to 30 million streams online. Because before, in previous cycles, and Tom, you know this, they had to play for the front pages of the newspapers, you know? But now they're playing for this thing. They're playing for the viral moment on your cell phone in order to see what's going to go viral and outlast on the social media feeds.
I agree. The whole distribution question and the permanence of it next time around is an interesting source of study. Kevin Cirilli, thank you so much for coverage this week. Somehow I think we'll hear from him again through this Friday. This is something that plays to Mr. Trump and plays to the heartland. The John Deere company says, well, the gloom isn't there, and they really come out with a reset of a lift across all of their third quarter. These headlines are coming out right now with operating margins of 14.6%, but I just want to state that it's a reset for John Deere with a little more enthusiasm to it. That's the kind of thing Mr. Trump will be playing on, as we just heard from the prescient Kevin Cirilli. Coming up next, I'm thrilled to bring in Nouriel Roubini. Francine and I will talk to Dr. Roubini about the moment we're in and the fiscal weight upon our budget. This is Bloomberg. Stay with us. It's a surveillance on Francine Lacroix for like 18 hours in a row. Donate. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning, everyone. Bloomberg surveillance yields in this week off the yield pop that we saw 4 or 5 days ago. 1.37 and the 30-year bond says it all. Sterling was at 132, now 131.60 on sterling. Mr. Barnier speaking on difficult Brexit discussions. We're having wonderful conversations. Robert Skidelsky with us moments ago, and someone from a different wing of the economic game. Nouriel Roubini joins us now from New York University Stern School of Business and, of course, of great acclaim at looking at crises. Professor Roubini, wonderful to have you back with us. You wrote in February or January of the white swans that are out there, stealing that phrase from Nassim Taleb as well. Where are the white swans of 2 years from now?
Well, there are some medium-term challenges that we're facing. We're in a world in which public and private debts are rising, and they're going to become even bigger given the response to the crisis. We have the risk of global pandemics becoming recurrent, global climate change. This Cold War between US and China is getting worse. Geopolitical risks are rising. There are serious political uncertainties about the US election, about the shape of the recovery. Started like a free fall, then for a while people thought it would be a V. This V is becoming a U. The U could become a W if we don't find the vaccine, if we don't have enough policy stimulus.
Nouriel, I want to look forward, given the assumptions and certitudes that institutions have right now. The great model, Nouriel, that we have is there's a bridge out there and we should invest or act according to that bridge. Do you believe in the bridge, and can it get us to 2022?
I worry because before the crisis, there was a massive leveraging of the corporate sector in the United States, but also in many other parts of the world, including emerging markets. And given the COVID shock, most firms have to deleverage. Deleverage means to spend less, save more, and doing less capex because there is a glut of capacity. Now, how you spend less, your main costs are labor costs. But your labor costs are my labor income. So the deleveraging of the corporate sector implies that there'll be much more sluggish labor income. First, the workers are fired, and if and when they're going to start to be hired, they're not going to get full-time jobs with full wages and benefits. There'll be more gig workers, part-time workers, hourly workers, contractors, freelancers. That means a huge amount of uncertainty and risk aversion by the household sector that is also highly indebted. So you're going to have also deleveraging by the household sector that have to spend less, save more, and do less residential investment. And that deleveraging of the private sector implies at best a sluggish U-shaped recovery. And at worst, if we're not doing the right things in terms of controlling the virus and we don't find the vaccine, that U could become even a W, a double-dip recession.
But Nouriel, if you look at the markets, they're going up. So, you know, you've basically, you're saying that we're going through 10 years of misery. The market keeps on going up because of central banks. So, you know, who's right? Does the economy catch up with the market, or does the market catch up with the economy?
Well, as you pointed out, we have zero policy rates, if not negative. We have long-term interest rates in the U.S. at best at 60 basis points, in parts of the world, zero, if not negative. Central banks are even buying high yield and high grade bonds, so those spreads are squeezed and you don't get much in credit or fixed income. And therefore people are going into stocks, but not because there is a very strong recovery of earnings. I mean, you have, 5 companies, the big tech within the 500 of S&P that are doing well. The rest of them are not doing well. So it's all driven by further multiple expansion rather than a real recovery. And what's good, by the way, for Wall Street is bad for Main Street, because Wall Street represents what? Big firms, big tech, and big banks. What's Main Street? Workers, households, and small and medium-sized enterprises. We know that hundreds of thousands, soon enough, of small shops, retailers, and others are going to go out of business, while the market share of big business is going to rise, and that's driving Main Street down. That creates tons of jobs in the SME and makes the big firms even bigger in terms of market shares. And as I said, if the firms are going to survive and thrive and achieve the earnings target by slashing labor costs, your labor costs are my labor income, my consumption, and eventually that slump of consumption is going to weaken earnings and profits down the line. So I think that the stock market doesn't reflect the real economy. Mainstream is struggling. It's struggling severely.
We're also focusing a lot more on health. We're also focusing a lot more on climate change. Governments are doing that across the world. Does it mean that the pandemic is actually ending our obsession with economic growth to focus on other things?
Well, it might in the short run, but now there is some clear evidence that these zoonotic diseases that are transmission from animal to human that are occurring much more frequently. We had HIV, SARS, MERS, swine flu, bird flu, Zika, Ebola, now COVID-19, soon enough there might be even more virulent, is driven by the destruction of ecosystem that imply that animals that are wild, that carry these diseases, are closer to livestock and closer to human. So if we don't address the destruction of the ecosystem, the global pandemics are going to become more frequent and more severe. And this pandemic alone has done more economic destruction than any economic and financial crisis in the last 70 years. So thinking that we should not worry about the environment doesn't make any sense. Actually, we have to invest into environment control, because that's going to be creating jobs.
Nora, let's come back. I want to come back with Nora Rubin. I really want to talk about the philosophy of how we're helping people harmed in this pandemic. He is at New York University. Later today, this is really timely about the actual assumption that's out there given this crisis. Christopher Ailman will join us. Sure, tech to the moon. I'm sure they got tons of Apple, tons of Amazon, and all the rest of them. But what about the assumptions forward? That's this afternoon. Mr. Ailman of Kelster. Stay with us with Nora Rubini, Francine Lacroix, and Tom King. This is Bloomberg Futures Flat.
gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. Not a usual Friday, and we've tried to pull together good conversations to get you ready for the weekend and, frankly, to get you started on that back-to-school, that back-to-work September feeling. You can always do that with Noel Rubini of New York University. Of course, we've known him for years, and his prescient view has been wonderful, and particularly his old world view, what he brings from his heritage and, of course, from his education in Italy over to America has been absolutely unique. Nora Rubini, I want you to take an old world study of how America's struggling to do income replacement. It's understood in Germany, it's understood in the continent, it's understood in the United Kingdom, and America is struggling so hard with aid, with stimulus, and with the idea simply of replacing income. Why is that?
Well, historically, people were criticizing the European labor markets for being more rigid and not as flexible as the US. But during this crisis, the European system seems to have worked much better.